When the levee breaks. Good morning, everyone. October 1. Another day in paradise. Just for the heck of it, I think I'm going to start doing this regularly. I kind of like this. I like reading about history. This day in history, I'll just read a couple from here. I'm just going the Wayback Machine. Wow, it's hard to imagine. It says here, 2017, October 1st, 2017, from his hotel room in Las Vegas, 64-year-old gunman Stephen Paddock opened fire on a music festival, killing 58 people and wounding hundreds. Wow, that was 5 years ago? Time flies when you're having fun. 1975, I remember this actually. In what is regarded by many as the greatest prize fight of all time, the Thrilla in Manila. Muhammad Ali defeated Joe Frazier. That was a good one. 1971. Wow, I'm really dating myself. 51 years. The Walt Disney World Resort, a complex near Orlando, Florida, opened. And the last one, 1961. Roger Maris hits his 61st home run of the season, breaking Babe Ruth's record. For those of you that are Yankee fans or just baseball fans, we've got Aaron Judge trying to break Maris's record, and I think it is the record. Remarkably, I think Maris is only number 7 on the list now because of all the steroid, those bogus seasons with Barry Bonds and Sammy Sosa, etc. He's only 7th, but I'm an old timer. In my view, Maris is the real deal. All the other ones are tainted.
If Barry Bonds, what's the record? Is that 71, 72?
70, 73, 73, I think. Yeah, go on.
So after that whole steroid era, what was the max? I don't know the answer, but I kind of want to go look. What was the max home run average over the next several years?
Oh, the maximum. Someone should look it up. I don't think no one's hit over 60. I don't think since then, and that's why this is so. Maybe one person. I mean, and certainly no one over 60. That's why this is so exciting now. So Rob, that's your assignment. If you go look that up right now, the last few years, Kantrow's question. Since then, what's been the most number of home runs hit? But Kantrow, seriously, this is actually a lead. Sorry, go ahead, Kantrow. Go ahead.
Let me see if I can. I may be ahead of you, or maybe just thinking, where are you going with this? Are you going to start putting asterisks on portfolio managers that crushed it during the steroid era?
No, what I am going to put it where I'm actually, you're close. It's a variation on a theme. Where I was going to go with this was, and we're pivoting here. We're just making this up as we go, and let's turn this into a free for all. I don't really care. So just like Major League Baseball, I mean, the cheating started with the steroids, and they looked the other way, and they didn't do anything about it. They were cool with it because they're making, management teams are making more money. I mean, it was collusion between the owners and the players, and everyone's making more money. Well, the same way you look at the street, okay? You started all this cheating going on with non-GAAP accounting, all the nonsense, with stock-based compensation, lockups, companies coming public, they jack them up, the public gets in it, 10, 20 times the price. The whole way the street has basically, the whole thing's been corrupted. And listen, the streets never have been for Boy Scouts. We get that, all right? But the level of theft and malfeasance and bad behavior that's gone on in this last, decade or two has taken it to a whole nother level. And so I would say it's really the lack of integrity because, people point out how I get angry and heated. But I've also been told, but George, we get it. You're just pissed off because you're trying to speak from your conscience and it just shouldn't be. Well, same thing happened to baseball. So that's where I would go with it, Kantrow. I don't know. Do you want to work that into your hope methodology, Kantrow?
Well, no, I think you make a good point about what caused all the excess, and we think about bear markets make you appreciate bull markets. Can you imagine if we have all these bear market rallies, and we'll probably have a few more. Can you imagine if in a bull market every 2.5 months we had a 15 to 20% correction? How much thinner and smaller Wall Street would be?
Yeah. So Kantrow, let's go with that. Let's go with that. So these bear market rallies. I mean, we just spoke yesterday, and again, I'm just going to second the motion. Sorry to embarrass them, but yet again, after having spent an hour with Kantrow on the phone yesterday, I'll say to you that must follow the best the best strategist in the street. And Kantrowitz, what I want to know is, first question, how did you get to be so impressive, despite your tender age? Kantrowitz, how old are you, please?
I used to be young, 41.
41. How'd you get so smart? Seriously, but seriously, all kidding aside, who were you? Who were your mentors before, and who did you learn from? I knew you. I knew you're the BASF of portfolio management. You take someone else's system and you make it better. But who did you work for?
Well, I'll try to make it really short. 20 years ago, when I started working at Merrill Lynch, my parents gave me a UTMA account that my brother had told them 2 years prior, in March of 2000, to put it all in Merrill Lynch Global Tech Fund. March of 2000. It wasn't a lot of money. In fact, I think it was $10,000. So when I turned 21 or whatever, I got the UTMA account when I started working. It was like $3,000, which was a lot of money to me back then. But I was like, what the hell? How'd you lose 70% of the money? And that lit a fire under my ass to kind of understand markets. And so 20 years later, I'm hopefully getting to that point where I can help people avoid such drawdowns, because we have the exact same setup today. But it's like you said, just from Mosaic. 20 years ago, I used to read blogs and have we used to have RSS feeds before Twitter, and I would just again take a Mosaic approach and try to piece things together that maybe I guess other people didn't see. I'm really handy around the house, so I can fix plumbing, electrical, pool, irrigation, kind of do it all myself. So I think knowing a lot, or at least a little about a lot, is kind of just who I am as a person, and so I think it lends itself to being in a strategy role. But I started off in Merrill doing quant, and worked with Rich Bernstein and a guy named Sasha Pradhuman in the early 2000s. Then I joined Ed Hyman, Nancy Lazar at ISI. Worked with a guy named Francois Trahan for about 12 years. And let's just say, when trying to put this, I was always working hard to impress people that would never give me credit. And so that just makes you work harder and harder and harder and harder. And for long enough, hopefully, that gets you smarter and smarter and smarter. And so that's, I think, just been a big part of it. And just, again, trying to piece together today. Everyone says every cycle things are different this time. I think a big part of my framework is identifying the major parts of the story that are the same. And in many ways, this bubble and the downturn thereafter, what we see ahead is just like the tulip bubble, or just like the South Sea China bubble, or the tech bubble, or the housing bubble. It's different forces, different actors, but it's all the same story, just a different, a new evolution of it.
Hey, Kantor, are there any particular aspects to this which are noteworthy in terms of things? And again, the pattern remains the same. I get that, but are there any things that have happened which are particularly noteworthy, which would then, with an exclamation point, put emphasis on some of the themes you're looking at? Or are there some things which haven't happened yet and you're looking for? Anything particular? So in other words, if you look at the inside baseball, no pun intended, the granularity of this cycle, does anything come to mind that stands out to you, or is it pretty par for the course?
I'd say big picture, it's par for the course. The difficult thing is, of course, trying to bring in the idiosyncratic parts of the cycle, the exogenous parts of the cycle, which each one has its own, and trying to figure out how that's going to influence the duration, the magnitude, and the timing of your core framework. But it actually wasn't until this summer, admittedly, I've been doing this almost 20 years, and admittedly, I've never gone back, just because we've never had this dynamic where I've had to go back and look what happened at through my lens, what happened at every bottom of the market. I've only lived through, I started in research in 03. I've only lived through one real recession bear market. Forget about COVID, that was different. And this is the first time today that we've had that similar setup of 07 and 08 in my career. So we just haven't had this combination of Fed tightening, inflation, all the things you see before a recession. And the thing that I keep going back on, and where I think a lot of these people calling bottoms, because when this happens, you're typically up a lot in the next 6-12 months, are not acknowledging, is that every market bottom is an economic bottom, and it's always a housing bottom, every single one. So, and it makes sense. That's not one of these stupid analyses of just when sentiment's this bad, this is what happens to the market. There's no context to that, because we don't know why sentiment was bad in each one of these different examples. But at the end of the day, you look at any sentiment table, any sentiment fund manager survey from Merrill Lynch or Bank of America now, every peak in those or every trough in those sentiment measures, they're all right around or right before, like within months, 2 months, 3 months, not 12 months, of a bottom in housing. Because you can't get an economic recovery unless you get a recovery and stabilization in housing, and therefore there's no earnings recovery. And if housing doesn't pick up, everything else thereafter gets worse. So, again, talking about a bottom today, I think just the burden of proof is on people that are calling for that, because unless housing is bottoming around the corner, history doesn't hold up to that. And that's happened across regimes. And that's the important thing today, is having a framework and analysis that's worked across all different types of regimes. And that's literally 100%. So it's not often in this industry we can say that. There's no guarantees. And of course, anything can happen differently. But that makes sense. It's happened every time, and we're nowhere near that today. So I think, looking for a bottom and thinking that, living through 07, 08, that, the BOE stepping in to plug up a hole, or the Bank of Japan stepping in to stop their currency from melting, or whatever else we're going to see, these are not going to put, we're just plugging up the holes in the Titanic. We're not going to bottom until the economy is close to bottoming, and we're nowhere near there, because we're in this interest rate, and we're in a rates bear market today that equities are a bystander of. Just like in 2019, we were in a rates bull market when Powell pivoted, that equities did phenomenal. It had nothing to do with earnings getting better. So I think contextualizing that is super important, and I think everyone, a lot of mistakes I see is people thinking of this as just a typical run-of-the-mill bear market due to earnings and the economy, and that's 90% ahead of us. And I don't think
Kantro, you've been very clear on that. And you've been so right. I want to have a little fun with you, if you don't mind. I want to play a clip. It's 1 minute and 20 seconds. Tom Thornton posted this. It's from Tom Lee, and we're gonna have a little bull bear debate in absentia. So I'm gonna let Tom Lee explain in his own words what he's thinking. And so here, I hope everyone can hear this. Kayfabe, I'm going to ask you to raise your hand if you can't hear this. I'm going to turn this on. So I just want to play this. It'll be 1 minute, Kantro. If you just listen to this, I find it comical, but let's play this. Hold on. Here we go.
It's going to happen in the next few months. Might say certainly is one of the last bulls standing. The question is, Tom, is that going to change anytime soon?
Scott, I think the bull case has been really bloodied this year. It's been 3 quarters of disappointing market performance. But for reasons that we've been explaining to our clients, I think a lot of these headwinds that have been really tough on stocks, especially inflationary pressures, I think the odds are going to favor a big turn in the fourth quarter. And I heard the debate in the prior segment. I think 1982 is really an important analog. In 1982, the market's focus was almost solely inflation. And it was really when the inflation pressures broke in a way that convinced markets is when stocks bottomed. It wasn't a Fed pivot. It was really when the market viewed a pivot as being realistic. And it's a reverse checkmark rally. The market goes vertical. In fact, when people talk about unemployment rate in August was 9%. It still jumped to 11% by December, but the stock market rose 50%. I think ultimately, if inflation breaks in a way that's convincing the next few months, you don't have to wait for the Fed pivot, and that's what we think is going to happen in the next few months.
All right, so George.
Yeah, you go for it, Kantro. It's T-ball time. I just put the ball up there for you. I'm walking away. Go for it, man.
So I wrote a report because, I don't listen to strategists. I rarely watch CNBC except like when I'm in a hotel getting ready and when I'm traveling. And the extent I hear other people's work, it's through clients kind of pushing it in front of me. And so I heard that clip, and he's been saying that for months now. That in 1982 we had 4 months we recaptured the whole bear market. So I wrote a report addressing that. Didn't name him, but I said this is not 1982, and this was again 3-4 months ago. And so I think he's dead wrong on the catalyst. If you look at the market bottom in 82, the Fed had been easing. Inflation peaked more than a year ago. What happened in 92 that put in the bottom of the market? Again, I'm a freaking broken record here. Housing bottomed. The ISM shot up 20 points. The whole economy bottomed. Unemployment was much higher. Claims were much higher. The whole economy globally rebounded. Everything was, that's it. Plain and simple. It had nothing to do with inflation. He's dead wrong. The Fed had been easing, and we finally got to the point where the lagged effect of all that easing had caught up and shifted the economy in a massive way. So listen, we may have a rally in the fourth quarter. We're kind of getting close to that point where we're going to get another bear market rally. But this is the thing I've heard a lot is, hey, when CPI peaks, the market bottoms, or when the Fed stops, the market bottoms, or when this happens, the market bottoms. You have to look at all of these things together. CPI, PMIs, housing leading indicators. There's actually never been a bottom in the market where CPI has peaked, and that's it. Anytime there's been a bottom in the market near a peak in CPI, and again, that's not what happened in 82. CPI peaked over a year before that. It's always come with a major economic recovery in the ISM, the NHB, or housing starts. That's what happened. Anyone go look at the data. Maybe I'll tweet the chart again just so you can all see it. I think he's dead wrong on the catalyst, and there's no history that supports the point he's making. Again, not saying the market can't rally next. Again, we're going to have another bear market rally. We could talk about what the catalyst for that could be, but we're going to new highs, and no way in hell unless we see a bottom in housing and PMIs, and everything I look for that forecast those that have been reliable indicators for 70 years, not 5 years, not 10 years, it's all pointing down for another 9 to 12 months. So I don't know what he's looking at. I think even the story he's telling just doesn't hold up. At any point does he mention, look, the economy massively rebounded? No. How the hell do you leave that out?
Hey, Kayfabe, do you want to say something?
Well, if you'll indulge me, I wanted to make 2 quick comments on the baseball topic that I didn't get to say. If that's all right, George.
Please.
Yeah.
No, baseball is the most important. Go for it.
Right. Well, I'm a huge baseball nut. Have been since I was a kid. I'm a little older than Kantrowitz. I'm sandwiched in between the two of you. I'm 47. So, but I know a lot of the history and the statistics of the history. So the first thing I wanted to say is that a pet peeve of mine is this discussion that happens relative to the steroids era and how amphetamines were such a huge part of the game all the way back. And I always just try to point out there's a difference between performance enhancement and performance enabling. So just because guys were taking speed to play the day after they were out drinking all night is different than bulking up your muscle mass in order to hit the ball farther. So that's the first point. Second one is what makes Judge so unique is that he's basically got the physical profile of the steroids guys because he's a freaking tight end playing baseball. I mean, he's like 6'7", 280. So he's got the strength of Paul Bunyan without having juiced and cheated. So that we know of, obviously, and certainly hope that's not the case. And I hate the Yankees, so that's obviously not a reason that I'm rooting for the Yankees. And just to put all this in context relative to Babe Ruth. So Babe Ruth's career slugging percentage, and slugging percentage is basically total bases divided by at bats, was 690. Judge's season this year is 695. Barry Bonds did not have a season that was at or near anywhere near Babe Ruth's career average before he went on steroids. even into his peak. And that's a good way to look at the steroid era guys. If they have big slugging percentage years that are above their mid-20s slugging percentage in their 30s, that's a huge red flag. So guys like Bagwell and Jim Edmonds, Mike Piazza, they put a bunch of guys in the Hall of Fame, not Edmonds, but they've already put guys in the Hall of Fame that were clearly, I mean, if you know how to do any kind of statistical analysis, that were clearly doing steroids that got in anyway. So just wanted to throw that out there.
100%. 100%. It's the lack of integrity. And on a serious note, and I thank you for that, Kayfabe. On a serious note, and I was being tongue in cheek, it's just a lack of integrity everywhere. Lack of integrity in institutions. It's the market.
George, you could also say it's not necessarily all integrity. It could just be lack of or too much luck, right? If stock markets go up all the time, a lot of investors can, Wall Street has been meant to go up. So just thinking, what other industry, when it slows down, does it get juiced up again and again and again? So there's like in baseball, there's analysts that hit 200 and there's analysts that hit 350. And I think we've just got too many that are around because of that this continuous backdrop of trying to kill the business cycle, kill bear markets. So that's why a year like this year, again, I've been wrong plenty of times in the past. I will be wrong in the future. But I try to always show the reasons we come up with our ideas in multiple different ways, and this is going to separate the strong from the weak, as we've seen year to date.
Yeah, no, Kantrowitz, fantastic point. Let's go into that point a little bit more. Then I'm going to come back to the point I made, and what it really speaks to is process. And I know you are a big believer and adherent to process-based approach to markets, and yeah, anyone can raise their hand and get lucky on something. I've done it. We've all done it. But I think I put out one of these tweets this morning. I'm not gonna find it here. There's, those who are narrative chasing, value ignoring, CNBC watching, are now getting something to the effect of getting an expensive education. And so it's all about process. And in that over the cycle, and I think it's important. I know it's what you promulgate, so I'm not showing for you, but I think I'm trying to channel my inner Cantro. It's what a lot of people don't understand about this business, and we've been particularly in this prolonged cycle, and I know Kayfabe's going to weigh back in on this, as will Rob, in this prolonged upcycle, at least since the GFC, and you can go back even further to all the excessive excess liquidity that was being created, going back to Greenspan actually. Never let a good disaster go to waste. I mean, just more, spike the drinks, more drinks for everybody. And so, but it's gone on steroids in the post GFC era. And so, what's really awful about this, and Kantrowitz, I'd like you to respond to this, and Kayfabe and Rob, in turn, is that the longer this goes on, the more the condition the investor base becomes into believing this is normal. And it's not. Anyone who studied financial history knows it's not. And it's capitalism is mean reverting. All right, you can't keep doing this endlessly. What I'm fearful of, and I'll read a great thread in a few minutes that somebody put up on Twitter last night. We're getting the mean reversion of that tidal wave of liquidity and all the attendant consequences of that. So beyond Kantrowitz, just the normal business cycle, the backdrop to this is, with apologies to Tom Lee, it's so different and so far worse, not just for the reasons that you cited, but it strikes me that given the long up cycle that we've had, the exaggerations have been that much more severe. And I remember tweeting last year, like, you look at the Japanese market, you look at 2000. Let's just talk about the 2000 Nasdaq, because you're probably more familiar with the domestic market than the Japanese market. And I'm going out on a limb here, so I'm winging it, and you'll probably shoot me down. But whatever, you can tell me what's true and what's not true about this. You just look at the extent of the outliers in terms of, and probably through your screens, Kantrowitz, number of stocks selling with 100 times sales, 50 times sales, whatever it be. I look at the extremes that we achieved in this upcycle, and then just the overall breadth of the overvaluation compared to, let's go back to Nasdaq 2000. There it was a more narrow affair because you had a huge disparity between growth and value. So, okay, so at least when NASDAQ blew up, you could buy Levitt's furniture, where the dividend yield was higher than the PE. It was like 6 times earnings and a 6% yield. So it was something to buy. And then guys like Jeremy Grantham, absolutely killed it. This cycle, everything got pushed up. It was the everything bubble. Some things more than others. But I look at what we've done here with the most irresponsible monetary policy in history, and how it's inflated the prices of everything. And we're now getting the opposite of that. We're getting the everything bear market. So, Kendra, I guess what I would ask you again, when I asked you earlier about juxtaposing this, cycle to past cycles, and yes, the overall strategy is the same. The song remains the same. I get it. But to what extent would you agree, disagree with that this one's been worse? And if so, what are the implications of that? First Kantrowitz, then Kayfabe, then Rob. Kantrowitz?
Yeah, you think about we've had a lot of bubbles, and you can trace these all the way back to decades. Every bubble's been a function of cleaning up the prior bubble, right? Just like 2000 was cleaning up, or blow-ups, right? The Fed massively inflated the market those last 2 years when they cut rates in '98, and then we cut rates, propelled the housing bubble. Cut rates propelled the everything bubble. Well, propelled the QE 2000s decade, and then COVID really kind of made it an everything bubble. But yeah, you've had a lot more valuation, more broad dispersion, because what's different about 2000 and today? 2000, the stocks that got the crazy multiples were really the ones that were supposed to grow, have these amazing growth returns. The last 15 years, growth, yes, has gotten a bid, but it's also been about, cash flow stability, visibility. There's more attributes that investors have been paying up for since '08, because all of this monetary policy has kept so much crap alive. So at least in 2000, the cheap companies were quality companies. A lot of value companies were lower beta, higher quality. They were just left behind during the tech bubble because they didn't have sexy growth. Today, a lot of what is cheap, whether it's relative or an absolute basis, has been cheap because it's crap, and it's only been surviving when the tide goes up. So again, it just makes you want to pay up for anything that provides, decent balance sheet, good cash flow, good visibility. So it's been far broader in terms of the factors or the attributes of companies that investors have paid up for. And so we don't have those high quality cyclical companies like in 2001 to fall back on when you did have a nice bull market in some of those in small cap value, for example, or in financials in 2001. You don't have that today. So I know that's kind of, I think, the biggest difference between today and 2000. The question is, going forward, as investors have now gotten burned by growth stocks, especially those with no earnings, and the view that inflation's not going back to where we were before, we'll see where that evolves. But what are the attributes going forward that investors are going to be paying up for in the future? And I think we're going to be in a more volatile world going forward, because we don't have consumers that can leverage up and create a boom like we had in the 80s and 90s into the 2000s. I think central banks are at the end of their run here, at least, creating the ability what they did the last decade. And governments, because they've cleaned up all these messes, are also tapped out. So what's going to create the leverage in the system to create booming earnings that reduce risks and make returns go up massively and limit volatility like we saw in the 90s or in the last decade? I don't know. So I think we're going to see far more volatility in the business cycle. And I think just plain old stability and, stuff like healthcare, where at least you have a demographic tailwind. It's an unfortunate one, right? But a lot of people are going to be dying in the next 20, 30 years of the baby boomers. I think stability is going to be kind of the next bubble in the next cycle.
Well said, Kancho. Kayfabe or Rob, do you have any thoughts on that question?
Yeah, I can. I'll just two of them. The first was the comments you made, George, about kind of I don't know, I'll call it the morality of all of this. So in my mind, there was a 4-year period from 96 to 2000 when 3 big things happened that set us up for this kind of never-ending period of financialization, as I know you've been calling it, George. The first was the Boston Commission in 96, where they basically institutionalized, as I call it, phony baloney inflation or fake inflation. So we've been pricing risk off of fake inflation for 26 years, and it was done intentionally. It's all public. It was done to cut long-term entitlement liabilities. So then in 98, the New York Fed became all powerful when we bailed out long-term capital management. And that was the first kind of moral hazard thing where, if you're a reckless asshole, really pay any real price as far as pain goes. And then in 2000, 99, 2000, when they got rid of Glass-Steagall, and we might have the next Treasury Secretary was one of the people who was at the forefront of that. And that, again, created all this mess within the context of the investment banks then merging with the commercial banks. And that's how we got the fun of 2008. And probably looks like more fun with Credit Suisse and some of these other guys. So that's the moral part of it for me. And now you've got all these gambling leveraged assholes that put a gun to the government's head every time that they blow up and say, oh, God, mom and pop's pension's going to go to zero, or the whole global economy is going to melt down if you don't bail us out again. And it's this never-ending feedback loop of leveraged assholes going to beg for mercy, so to speak, and none of them ever really having to pay a price. So that's my moralizing part. The second part on the economy, and I agree with Kantrowitz on this. I've been using kind of an analogy. If you'll indulge me, I don't think I've shared it with your space yet, but I think it's a good one, George. Which is, it's like forest management, right? If there's a long period of time where a lot of dry tinder grows on the floor of the forest, and you don't have any kind of a fire, the risk of a forest fire grows, and it's an exponential growth. It's an exponential function, and we haven't had a forest fire, so to speak, in the economy since 2009. 2020 there was no Schumpeter aspect to the 2020 recession. So we have basically 13 years of no fires. And what's very dangerous about this cycle is that normally just the normal rhythm of the business cycle, global business cycle, when there are forest fires in North America, like, the US has a forest fire, i.e. a recession like we did in 2008 and 9, there's breaks in the forest, right? So China didn't go into recession in 2009. They actually just slowed down from, let's say, 11% to 8% GDP growth. India was similar, just slowed down. So that kind of created a natural barrier as a shock absorber for the fire or the recession. Well, what the pandemic did and all the lockdowns is everyone kind of rebooted their business cycle at the same time within a very small amount of months and a limited amount of months. And that removed all of the normal breaks in the forest to prevent a spreading of the fire. So we've basically got 13 years of no burns, and all of the breaks in the forest have been ripped down because of everyone rebooting at the same time in their business cycles. And that's why a synchronized global recession, which we're in the midst of now, I think anyway, it's clear, with the US kind of being dragged down, maybe China leading us into it. That's why this is so dangerous, is because of the amount of dry tinder, all the leverage, no real cleansing or Schumpeter forces that haven't taken place in 13 years, and the whole world's doing this at the same time.
Really well said, Kayfabe. That's tight and concise and really, I think, fits what we're looking at beautifully. I don't know, Rob, did you want to say something?
Yeah, thanks. This George's room is moving so fast. It's like that scene from the movie Airplane, now arriving gate 41, 42, 43. So I'm going to try to bullet point a few things here to maybe foster a broader discussion on these topics. So first of all, as far as your analogy that you were looking for with the football, somebody told me a long time ago, you can't hit a 9-run home run. Okay? Never happened, never will. You can't get it all back at once. And similarly, you can't take everything the Fed has done since, let's say 2016, and just reverse it in a matter of a short period of time, unless that short period of time includes a crash, which nobody can really anticipate perfectly. That's one. Secondly, as far as Tom Lee, I actually go back. I mean, I've talked to him a long time, see him on television all the time. But I go back to Tom Lee when I worked with him at Morgan Stanley in like 1993, 94. He was the second in command, heir apparent to Byron Wien, who is a Wall Street legend and who would tell it like it is and take both sides. So I guess I don't really know where Tom went with the Uber Bowl thing, but it's there. Also, 1982. I mean, let's go back and ask the investment population of 1982. It's completely different from the investment population of 2022 for reasons I'm sure we've discussed here, and we certainly can. There was no retail investor presence. I mean, it's completely different. So it's really hard to go back to a period like that. I think 2000, fair comparison, and 2007, 8, 9, fair comparison. And most of those people were investors then, and they are today. Next point, if you want to maybe try to put into non-financial terms what the last several years of Fed pumping, creating the everything bubble is like, go back and watch an award-winning documentary called Super Size Me. It's a guy that for 30 days, he eats McDonald's 3 times a day, and he measures constantly what happens to his body. And at the end of the 30 days, you can only imagine, I like junk food like anybody else, but 30 days, 3 times a day, and his body in 3 days went from pretty healthy to, get this man a room in the hospital practically. And so again, he could not just say, okay, I'm done eating fast food, problem solved. It was going to take him, and I think he may have documented this, several months just to get himself, maybe a couple of years, to recover from what happened in the 30 days where he was throwing junk at himself and giving himself no mercy. And to me, that's a beautiful analogy for what the retail investor and maybe a lot of institutional investors and permeables don't understand. Very last point, when you because the title is Room, right? It's Oversold. My dad taught me to chart stocks when I was 16. He never did it professionally, but one of the things he taught me was the biggest mistakes you make as a technician is when you follow an oscillator, you see that it's overbought or oversold, and you don't appreciate the fact that oscillating indicators, which is a technician's way of saying overbought, oversold, they can get pinned. That's the term that he used. They can get pinned at the top for long, long periods of time, and that is what extends bull markets. It's also what makes the market more dangerous than most people, I think, except for this room, are giving it credit for. And that's my take.
Wow, Rob. Listening to Kantrowitz, Kayfabe, yourself, I mean, just I thank all of each and every one of you. It's just fantastic. Really good insights. I want to read here a tweet. It's a thread. If someone wants to throw up in the nest, they can, but I'll get up there later. I'm having problems with the app today. For some reason, my tweets aren't going up into the nest. There's a fellow, one bubble to rule them all. One bubble to rule them all. He just tweeted out a thread last night. I'll just take a minute or two to read this, and I'll read it slowly, but I think this is really important. Important to keep an eye on the main story. You can think of every single global risk asset as being priced off the U.S. long bond. Due to QE, the long bond was wrongly priced. Now it is normalizing. Every single global risk asset, equities, real estate, whatever, should have a risk premium on top of the U.S. long bond. Due to QE and Keynes' animal spirits, this risk premium became effectively zero or close to zero over the last few years. Due to the suspension of QE, every single global risk asset is now being repriced against a normalizing U.S. bond yield and normalizing risk premium. This, in effect, means that the discount rate for each and every asset hold on a second here. Just a minute. I'm terribly sorry. Yeah, this in effect means that the discount rate for each and every asset, global risk asset, is rising by between 2 and 10%. The effect of raising the discount rate for a risk asset from low single digits to mid to high single digits will cut the value of every single global risk asset by 20 to 50% or more. Should inflation remain sticky, this downward repricing will not be reversed, unlike the dot-com bust and the GFC. That's something which, the new investor crowd doesn't appreciate. We are at the start of a likely permanent, and Shrub, you got to get up here because I'm talking dirty to you now, man. I'm talking bear to you. We are at the start of a likely permanent, once in a generation downward pricing of every single global risk asset, after a likely permanent, once in a generation upward repricing of the discount rate for all risk assets. And here comes the closing. Pay attention. Despite the year-to-date decline in global risk asset prices, investors have still not grasped that, one, the repricing still has a long way to go, and two, there will be no rebound at the other end. Again, the repricing still has a long way to go, and there will be no rebound at the other end. And Shrub, I'm going to turn to you in 5 seconds. Everyone who's piling on bearish or whatever, it's like, now it's now everyone's like, you're too bearish. The same people who were giving me crap at the beginning of the year, and in the markets, everything's done a face plant, and Kathy's down 60. Excuse me if I remind them of that call, they'll say I'm trolling. Well, the same people who wouldn't give me the time of day at the turn of the year are saying I'm too bearish. They just don't get the plot. They don't see the big picture. They don't see Kantrowitz point about we're just starting the down cycle for earnings. I just want to put a bullet through my head. So in any event, I'm going to turn it over now to Shrub, and that's going to let the master, great friend of this room. Everyone's got to follow Shrub. He's been so right on everything. We see eye to eye, and I hope, Shrub, if you and I start laughing together this time, as you reminded me the other day, we were laughing about the bonds a few months ago at 3%. So Shrub, take it away.
Hey, buddy. Sorry, last time I was a bit intoxicated, and I had a great time being on your spaces.
Yeah, but you know what? You were even better intoxicated. I like you better.
Well, right now, while you guys are talking about baseball, for me, it's porcini season. So it's these wild mushrooms in Italy. So I have a ton of porcinis around me, and I'm just cooking while we speak. So I'm enjoying my equivalent of baseball season. But anyway, so on this, when I had the spaces under the influence of alcohol, I made a comment that I want to clarify based on this thread that you described. So I said that I'm buying 2-year treasuries, okay? And I said, and I tweeted out something that most people didn't understand, so I might as well explain it now. And I said, I'm buying 2-year treasuries because they're at 4.3%, and I'm sitting on a lot of cash, 70% right now to be exact. And if the 2-year is at 4.3, it means, if the 2-year is at 2% and the 10-year is at 10%, it means that US investment grade should be at 6%, and it means that high yield should be at 8%, and it means that equity free cash flow yield should be at 10%. So I gave you 4 asset classes. Oh, and by the way, crypto should be at 0, right? If you put all those things together. So I just gave you a very simple capital structure lesson there. You have a capital structure. You start from the safest asset. You go up to the senior secured. You go up to the senior unsecured. You go to the junky high yield, and then you go to the equity. So when you value things, which people don't really do anymore because it's all about the narrative, you just put a bloody premium, risk premium on every tranche. So if I'm buying the US 2-year at 4%, and you're not buying it, it means that and you're buying equities, it means that you think that your equities, your blue chips, I'm not talking about mid cap, your blue chips should yield you 10%. So that's not an S&P of 4,000. That's an S&P below 3,000 at best. So that's point number 1. Point number 2 is, and I think, this was very well highlighted by Kantrowitz many times, is, okay, so you want to hide in blue chips. Great. So you bought some Nike. Okay, great. Well, their inventory just bloated and they're going to be dumping shoes for the next 12 months. So, you just lost 50% on your blue chip. So, when reality hits in the real world, doesn't matter if you own a blue chip or not, you're still going to lose money. It's that simple. So it goes back to my point. If you see your blue chips getting killed the first place to go, it means that the economy is slowing down. So the first place you should be looking at is the short-term short-term U.S. Treasuries, and that should be your benchmark for comparing everything else. And I think a lot of people are going to lose a lot of money in the next few months just hiding in blue chips like Nike. Great companies and all that, but wrong price and wrong EPS. Because I don't know about you, but I've never made money buying a stock with declining estimates, and this is what's happening. You're buying a great company, but in a declining estimate environment, and that doesn't really work, unfortunately. So I'm sorry. So even if and given the margin pressures, by the way, I think this is the other thing that people are really underestimating, because labor is tight. We see it in Europe, by the way. I mean, Europe, for all its bearishness, labor is really tight here as well. So that obviously impacts the margins. So you could have a scenario where growth isn't that bad, but your margins are getting destroyed. So again, that points to that. This is what stagflation, inflation pressures do, and that's why the bond market isn't actually. That's why the 10-year is not at 2%; it's at 4%, because actually those inflationary pressures are still in the system. And which is exactly why I only look at the short end of the treasury market to give me hints about where the world is going.
Hey, Shrub, let me ask you a question. I couldn't agree with you more. I'm one of my highest conviction levels that we are in an earnings bear market, and Kantrowitz will talk in a minute, and he'll talk about that. But for all the reasons that you very eloquently laid out. But Shrub, let me ask you a slightly different question. In talking with a couple of European friends, I think in France actually, they're like, hey, in the Netherlands, hey, gee, things are actually okay here. The housing market's still. My Dutch friends said the housing market's still on fire. Blah blah blah. You go out, the bars are still full. Blah blah blah. And so we're sitting here over in the U.S. and we're very insular people, and you read enough zero hedge articles and what's going on to have a cold winter in Europe and the Russians and all that other nonsense. And you'd think Europe was already in a depression, but can you just speak sort of from everyday life when you go around? Like, would you even know that there's this upset going on in financial markets right now, or are things pretty still okay in Europe as far as the man in the street is concerned? Shrub, can you unmute yourself, please?
Oh, yeah, sorry. So
Yep.
the saving grace in Europe is that the labor market is very good, which is the saving grace in the US as well, by the way. So when you have a tight labor market, and actually people don't really want to work here because they got their nice benefits, and they got the benefits for the energy packages. So, for example, in the UK, the energy bills should have gone from 1,200 to 5,000, but instead they capped it below 2,000. So that would have killed the UK consumer, but instead it gave him some breathing space. And again, you have to differentiate the different markets. So, for example, in France, where I'm close to France right now, their mortgage is a 30-year fixed, and their energy prices were subsidized. So, the person on the street doesn't feel it that much. Bizarrely, the only time I had more people complaining in the summer when the oil price went above, when oil was at 120. That's the time. And the other thing I've noticed, because now it's the Monaco Yacht Show, and I think I told you during my intoxicated phase that it's actually the busiest yacht show they've had for ages. It's full of Americans, Australians, and Greeks. They're just coming to spend their spoils of the commodity market. So it's a very, very busy time. Spoke to a broker a bit earlier, and he said, actually, we're really surprised. These, the Americans are coming in and filling the void from the Russians, but obviously not as flashy as the Russians. So there is American money coming now here to Europe to take advantage of the low, cheap currency as well. And also the other surprising thing I've had talking with banks was that demand for real estate is actually quite strong because people are panicked about their currency depreciating, which, I don't think you have that kind of feeling in the US, but imagine, my generation. So, I'm 42, and I grew through the Greek drachma, the Cypriot lira, the Italian lira. So I actually witnessed the Greek drachma depreciating 3 times, or the Cypriot lira depreciating 2 times. So, I lived through that, and I'm only 42. So the guys in their 50s, they know they know about this, right? So their natural defense is that they're going out to buy real estate because that's the easiest thing they can do, and also they're trying to lock in some rates. So bizarrely, the real estate market is actually quite strong in some areas with cash buyers. Now, okay, caveat to that, I remember very well 2008, because in 2008, if you think you're bearish, we were 100 times more bearish than you are now. And in 2008, we were watching the system collapse, and it was, you would go to the clubs and everyone would be partying. And then I remember well, US funds were buying in Europe as a safe haven against subprime. And I remember exactly the same thing, the Europeans saying, oh, this subprime is contained in Europe. So there's always, when the Titanic is sinking, the band keeps playing and some people don't realize. So I don't want to be in the, we're safe camp. I want to be in the people don't realize and they act according to their instincts camp. And, in 2008, by the way, I was just going through what Trichet did. So I remember 2008 really well. So in 2008, Trichet, who was head of the ECB at the time, he actually, in June 2008, he came out and he was talking about inflationary pressures. And it was the famous Trichet rate hike. So we're kind of you do get some glimpses, some flashbacks of 2008 when you see this behavior, I think. Because you see the train wreck, you see the slowdown coming because, we monitor it closely, right? We look at the asset prices in the stock market, which is the first thing that reacts fast. And it's like the central bankers in a different way, in a different planet. So Trichet, it was when he was doing it in 2008, he was saying about, fighting persistent inflation, blah, blah, blah. And then 3 months later, the world collapsed.
Yeah, so Shrub, just stay on that point, and then I'll answer to weigh in. So your last point about Trichet and needing to rates more. I know there's some economic data out. I mean, you were talking a second ago about, bizarrely, the real estate market stays strong in France, and the average guy in the street isn't seeing it so much, seeing it first in the financial markets. And you rightly pointed out that some of the same things happen here in the States, and so you see some economic data. I think it was consumer survey or whatever it was. That's some inflation data as well. It's still hanging in there, and so doesn't that mean to you? And this is maybe you want to elaborate your comment about Trichet. The extent the economy's hanging in there, it's actually not a good thing. It's a bad thing.
That's a bearish thing. That's a bearish thing.
Yeah, it's a bearish.
Of course it is.
Exactly. I think.
Of course it is.
I think Kantrow's gonna. I'm gonna tee it up for Kantrow. It's T-ball time, Kantrow. I think he said something the other day about the problem is it's not that something's broken; it's something hasn't broken. So Kantrow, take it away.
Yeah, we were hearing the same thing in the U.S. Didn't Yellen just said the financial markets are performing, they're functioning well, and Powell said the economy's fine. And it's the mandate and how they set policy, which is ass backwards. But I wanted to comment on something Shrub just said about blue chips, because I've heard it a few times from clients saying, well, to get to your forecast, and this was probably 3 months ago, we think market will end this year 3,400 thereabout. You have to get the FANG. These big Apple's got to fall so much. How can Apple fall so much? And FANG was popularized in 2014, as I remember it, and they did shelter the market from what happened in 2015 when the industrial economy collapsed with oil. And they did do pretty damn well, large cap growth stocks in 2018, the last time we had a tightening cycle, though it was obviously far more mild than what we're seeing today. So this idea that these stocks can't go down, well, they've never faced a tightening cycle, a global tightening cycle. They've never faced this environment. We have, again, this goes back to the point earlier, we haven't seen a broad tightening cycle, banks tighten lending standards, a shock of inflation, all the things you see before every single recession, a drop in housing. Blue chip stocks haven't had to face that, haven't faced that. FANG hasn't been around long enough to have faced that in 07 and 08. So it's just like comical that like all people can remember is, the last 10 years and not appreciate that like we have things, again, this is a fact, not an opinion. We have a situation today that we haven't faced in at least, since 07 and 08. And then the idea, well, this is, look at US banks are fine, US consumers are fine. We blew up the rest of the world, the US, in 08. Maybe this is the other way around, but, if you're going to tell me there's no excesses built up in the last 15 years that are going to blow up, I'll sell you a bridge. And we're only going to find them out as growth slows more and more, and we'll see all the actors that are wearing no pants.
Say Cantro, I want the last point you made about we'll find the skinny dipping as the tide goes out. Warren Buffett, please call your office. Shrub, I'd like you to address something because you're a sicko, and then after Shrub, we're going to go to Kayfabe because I can think of no two better guys who could answer this question. So, I think it was a French economist who once said, Bastiat is what you see and what you don't see, and it's what you don't see, which is that's a surprise at the margin, what gives us a good way to make money. So we were all surprised, I believe, if you go back in the Wayback Machine a week ago, the idea of UK pensions becoming a front page story.
Yep.
Like where the hell did that come from, right? Okay. So
exactly.
So Shrub, my question to you is, when prices move quickly, such as they have, it could be energy prices going to the moon, and utilities unhedged, for their energy exposure, or they're hedged but they get big margin calls because there's a mark-to-market loss, or you get interest rates moving very sharply, and you got all these gurus with their crazy reverse back slips, swaptions, payers, floaters, all this nonsense. Stuff happens. And so my question to you, Shrub, two parts. The first part's easy, the second part's hard. And the second part really doesn't matter. But A, don't you think, given the moves we've already seen, forget about what we might see, we've already seen, that's only a question of time before some whales, some big fish float to the surface. It's, the Gavcal dynamite fishing example, that some big fish are going to float to the surface. There are some people who are already bankrupt or in big trouble. We just don't know it yet. They may not even know it. It might be
for sure.
Okay, and so my question to you is, what's the likelihood of that happening? And if you think about it, who do you think some of the primary suspects are?
So let me tell you one thing I learned in 08 when I was a banks analyst. It was part of my many hats, and it was fun doing it at the time. And I was very, very short Barclays. And during the times I was doing the analysis, I was looking at the balance sheet. They actually had a ton of 50-year derivatives that they were selling to these funds. So they were selling, but at the time they were underwater because they were this pension funds were buying protection against high rates. They were hedging rates when rates were like 4%. And Barclays was giving them 50-year derivatives. But at the time, because rates collapsed, those options were actually making a lot of money for the pension funds, but actually were like really loss-making for Barclays, because actually the Barclays was giving them at like a very tiny spread. They were, and basically, to cut the long story short, the derivative sales guy was the only guy making money because he was getting a bonus out of it. And Barclays was at a deep loss because the cost of capital implied for that transaction was making like a few bips. But they kept that thing on their book for 50 years. And when we were looking at the bad bank, good bank scenario, they're like, who the fuck wrote a 50-year derivative on rates? And who cares? The guy is like probably retired somewhere now, so he doesn't care. Point is, the same thing happened at Credit Suisse extensively over the last few years. If you see at Credit Suisse, they have a securitized bond issuance backed by yachts of their customers, including a few oligarchs. So I don't know where that bond is trading, or if it is trading. But the fact that someone actually thought the stupidest bloody thing of doing a securitized bond on yachts, that is like
Shrub, stop. You weren't trash talking and joking. You're serious? Securitized?
No, I'm serious. I'm serious. Yeah. I mean, it shouldn't even surprise you because, I think I told you the story with, one prominent private bank is offering crypto products in Europe. So, was offering. So Credit Suisse is doing structured solutions. So they were doing like securitized yacht products, and also they were doing a lot of securitized private jet deals. And when Russia blew up from the war, they were, in their surprise, they managed to unwind that one because there was a big shortage of private jets at the time. So they got lucky on that one. But, let's go back to the excess of the system. If someone is writing a securitized yacht thing because he uses the last 10-year asset prices and suddenly no one buys a yacht because all the Russians are gone, well, what's the recovery value on a Russian oligarch's yacht? It's not that much, is it? So there's a lot of excesses. And the one thing I want to clarify, putting my banks analyst hat on, in 2008, it was very bad because banks were levered 100 to 1. And they were doing stupid shit like, putting subprime on their own books and doing this 50-year derivatives on that thing. So fast forward today, they're not 100 times levered. They're only 20 times levered or 10 times levered. The European banks are more like 20 times levered. Okay, 20 times levered is better than 100. But if you had like 5 years of easy money and you've done stupid crap like securitized yacht deals at best, and those probably are their better ones, then someone's going to have a rude awakening. And the guys at, let me just stick to Credit Suisse because there were rumors that they're in trouble, which I don't know. I don't know. Frankly, we're going to find out anyway at some point. But, Credit Suisse were the guys that financed Archegos, or however you call him, Bill Wang, Cathy's protege, or, Cathy's mentor, whatever he was. So when you have an excess, I mean, that's a pure excess by itself, right? You have a family office as if this random guy who blew up before, and you lever him up like multiple times. So, that was a skeleton that showed up. So I think my conclusion is banks they carry trillion-dollar balance sheets. And after I've spent, when I spend months going through them, I would find stuff that I couldn't believe existed. And, right now I haven't done the exercise because I frankly can't be bothered. But I'm pretty sure when you have a trillion-dollar balance sheet and greedy sales guys and women, you will find a lot of skeletons that are gonna float to the top, and people are gonna be like, where the fuck did this come from? Like this Bill Wang thing. Who the hell knew who Bill Wang was until like he blew up? Who the hell knew about the British pension funds until, this LDI thing until they blow up? We're going to find so many interesting things given the speed of these rate increases. It's just a question, if they manage to keep them under the carpet for that much longer.
Thanks for that, Shrub. Say, please stay. I love hearing you talk, man. Kayfabe, do you want to weigh in?
Yeah. So I actually wrote something about this a little while ago. It's like a Schrodinger's cat situation, which is, I think it was Einstein and Schrodinger debated about, the mental exercise was basically, if the cat is dead in the box, is it really dead until you open the box and see that it's dead, right? And there's an application of that with physics. But anyway, so there's probably all these dead bodies that are going to float to the surface. And progressively so, just like there was in 2008, just like there was in 2000 and 2003. Every major cycle has these. And the question is, when do you actually open the box to see it? And that information is not dispersed perfectly. There'll be people that'll find out before others and get positioned ahead of time. But they are there. They're going to be there. They're always there. So that's the first comment. The second one was about employment. There's a very interesting situation setting up here because of recency bias. Meaning that whether it's in Europe and the US, you have all these employers that have been starving for labor And that what that's probably going to do, at least in my mind, this is my thesis, is it's going to make them more reticent than normal to cut as the cycle turns over, as the earnings cycle turns, and they're going to retain labor for longer than they maybe should because of that recency bias, which actually is going to create a whole different feedback loop in the cycle dynamics relative to the dual mandate, the Phillips curve, all this alchemy that the Fed's using to try and project these things, where you could end up getting like a cascade later of people being cut because of this dynamic heading into it and the associated recency bias.
Yeah, Kayfabe, that's been my thesis all the way along, and I think we're both fans of Vincent Delaware. I don't know if I pronounce his name right, and he's written on this, and a couple other smart cookies have as well. I think you're 100% right, and therefore, going back to the profits picture, to the extent that companies are hesitant to shed labor, and Jim Bianco's in the audience, he can come up here because he's been out in front on this whole thing. The lever they typically would use to preserve margins, they're going to be more hesitant to use that lever. So couldn't agree with you more. Let's keep moving here. I want to go to McFly has been waiting for a while, and then we're going to do Neely. McFly, please unmute yourself.
Hi, George, and thanks very much for these spaces. I'm a property developer in London, and I just wanted to weigh in with regards to real estate. What I'm seeing here is we're only beginning to see the changes take effect. So, for example, buy-to-let, which is, if you like, investment property here, has just started to become more expensive. And now we're starting to see listings dry up and transactions come down. But this is very, very, very early. I'm also an ES trader, so I trade the SPX. And I noticed last week there was a lot of put writing. And I think it explains why the VIX didn't move down the way it should do once, you start seeing breaking of support. It's a very gradual decline. And I think there's a lot more to come. Everybody's expecting the bounce, but I think we're just very, very early in remembering 2008. So that was my general comment. I didn't have any questions.
So really good insights, McFly. I wanted to ask you, let's get into the sentiment here. Sentiment's the wrong term, but market structure. It's become, you want to talk about consensus thinking? Consensus thinking right now, to my way of looking at things, is it, the market's oversold, it's gone down, umpteen out of last umpteen weeks, therefore it has to bounce.
Exactly, yeah.
I take the other side of that. Last weekend, the chart that I'm sure you saw, the chart that made the rounds, if I saw it once, I saw it 100 times. That chart of the volume of put options traded, like all-time high in one day, and everyone says, see, everyone's bearish.
Exactly.
Okay. Now, I'm going to offer up something, and I want your reaction to this. So there was a guy I worked with early on in my career at Fidelity, Leo Dworsky. He was truly a contrarian investor, and he's now sorely missed. He passed away recently. And I learned a lot from him about the theory of being contrarian, and being a contrarian, it's a tough gig, and just being different for the sake of being different is no way to go through life. But I would actually argue. Let me give you an example. Let's say the oil price is going up, and it starts going up, and and all the tourists get dragged in, the momentum crowd and whatnot. So the consensus becomes bullish. And it keeps sort of, going up. And people don't really know, but they don't know the true reason why they're bullish. They're just going along with the narrative in the public square, and they're being seduced by price.
Correct.
But they don't really know why they're bullish. And I remember one of the best oil analysts I ever met, actually a great fund manager, Ken Hebner. He would get rather animated and excited. He'd say, no. And going back to Leo Dworsky, the real contrarian opinion in that situation is not being bearish of the oil price. It's being uber bullish of the oil price. If you really knew what was going on, in other words, the people that own it, they don't really know why they own it. They don't know the real reasons why they should be owning it. So this idea that the market's down and look at the CNN sentiment indicator and blah 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 blah. Therefore, I'm going to be a wise guy because that's obvious, and I'm going to be bullish.
Yeah, I mean, this is where I see it. I think we're in December or November when, if you recall, in 2007, when I think it was Credit Suisse came out with a report that there was a problem in the MBS, and we had that first drop in the S&P, about 4.5%. I remember I was a young pup back then in finance, managing portfolios, and I thought to myself, that was strange. That's, I think, roughly where we are. All we've given up really is the 2021 ridiculous rally, stimulus money rally. And we're just beginning to see, for example, here in the UK, today was the first day that the energy companies are charging the new rates for energy. But everybody's had that in their mind for the last 6 months, right? But it's only now that people's money is going to start to get squashed. And we're only starting to see the real estate market still very hot. And I don't buy that we've seen anything yet. So I watch every tick of the ES. I trade ES every day. I don't trade anything else. I've seen the way it comes down. It isn't trying to find a bottom. It is. It's not ready to turn yet, in my humble opinion. And I think it explains the reason the VIX is very subdued. And I think there's a pocket under there. I think we'll probably see it next week.
McFly, do you have the sense of, because this is something I've been focused on a lot relative to the potential for a nonlinear event. What do you have a feel for the scale of the put selling? Meaning that my sense is that it's been epic just by watching how markets are trading and, looking at skew and looking at the term structure and just the amount of open interest that just rolls through all these different strikes or expiries now. So do you have a sense on that?
Yeah, because look, option sellers are very sort of sigma related, and we've seen an incredible fall if you think how we've come down to reach this level. So you're looking at quite a big move. That is the perfect place to start selling vol, right? So everybody's jumped in to do it. And I think those guys are loaded and ready to capitulate, because if you saw that close on Friday, that was not a good close. That was
and they jammed implied volatility all the way down to like 28-29 for this coming Friday. I mean, that is not.
And that tells you the quantity that was sold, right? That gives you a feel for it. So I personally think Julian Brigden's spot on. I do think we're going to get a cascade to the downside. And I just don't think it's a good idea to look at historical precedents at this stage, just because of the way we entered.
Yeah, McFly, I couldn't agree with you more. I have one thing to say, and then I want to go to Jim Bianco, because I'm sure he's got some comments on this. And I'm just going to read a tweet from Tavi Costa from this morning. I think it's spot on. It resonates with me. I suspect it resonates with yourself, McFly, and Kayfabe. And McFly, I want your reaction to this, and then I want to go to Jim Bianco. Tavi says, I'm starting to think that the next leg down in stocks could look like the 87 crash. Liquidity is drying up. NASDAQ is about to break support, and the Fed is not stepping in for now. A big gap down could be ahead of us. McFly and then Kayfabe, then I'm going to go to Jim Bianco. McFly, what would you say to that?
Yeah, I agree. Look, we haven't seen the spike in VIX, so it's not done yet. I don't see this just being a very casual bounce back. I don't see it happening, personally speaking. And like I said to you, I think we are just at the beginning of this crisis. It hasn't started yet. So, typically housing will take a year to bottom after the stock market crash. We haven't had the crash yet. So it's due. So when is it coming? People are just looking at the blow off top coming off, but that isn't a crash.
McFly,
McFly,
it's the first time we speak. I really, really enjoy your comments. Please come back to this room in the future. This is fantastic. Kayfabe?
Yeah, some of the smarter vol and options people that I read and know have been talking about a gamma wall because of the selling that's gone on. And if you think about that, the way to ignite that selling pressure is a gap lower open because of something going on in Europe. So if you get a Credit Suisse go belly up Sunday night or some other time, and we gap down 2 or 3 or 4%, on a Monday morning or on a Tuesday morning, that triggers all of that put selling that's been going on, and market makers are going to have to flip, and then the put sellers are going to have to flip. And that's basically, to the point around the analog with 87 with portfolio insurance. That's basically what it is. You end up having a feedback loop of people that were offsides trying to capture something, and they all have to move at the same time in the other direction.
Wow.
That's what I see as well. Yeah. And
perfect. All right, our good friend Jim Bianco, Mr. Bianco, please weigh in. We've been having a party without you. Please join.
Yeah, some of your comments about the sentiment and the put buying. I just wanted to say that sentiment is not symmetrical. In a bull market, there is no such thing as overbought. I mean, we went all the way in the last bull market to FOMO and TINA, that it was just perpetual and you couldn't get bullish enough. In a bear market, you can't get, you couldn't get bullish enough. In a bear market, you can't get bearish enough. As I was jokingly saying, sentiment and these levels will go to apocalyptic or suicidal levels. Are we mixing the Kool-Aid in Jonestown yet? That's where we're going to go if this is a bear market, and it definitely appears to be. The great analyst Ned Davis once liked to say that I've got a set of indicators that work perfectly in a bull market, and I've got another set of indicators that work perfectly in a bear market. Tell me if we're in a bull or bear, and I'll tell you which one to use. But come to think of it, if you know we're in a bull or bear, you don't need these indicators. Well, if we're in a bear market, the indicators that you were using in a bull market, they don't work. You got to use bear market indicators. So when people get all exercised about record put buying, that was 2 weeks ago that we first heard about that. And we look at what the market's done. Yeah, that would have been great in 2019. That would have been great in 2018. But when we're off 25% year to date in 2022, that is not the level that you're going to see that would put in a bottom. Now, the market is chaotic, it's illiquid, and a lot of other things. So, anything is possible here, but don't think that the standard metrics that you would look for a buying opportunity from 3 years ago are going to work today. Second point I want to make, Friday, the 10-year yield finished up on the week 14 basis points, closed 682 from 382 from 368. And that's the 9th consecutive week that it has been up in yields. Goes back to August 5th. The last time it did 9 consecutive weeks was the week ending April 1st of 1994, 28 years ago. So it's been 28 years since we've seen a run like this. What happened the following week? The stock market was down 3.5%. Now, that doesn't sound like much by today's standards, but that was the worst week in 3.5 years. You got to go back to October 1990. Before that, the last time we had a string of 9 consecutive weeks was October 16th of 1987. We all know what happened the following week. That was the stock market crash of 87. And before that was May 25th of 1984. So what I'm trying to say is the string that we've seen in the bond market of 9 weeks in a row up, it's only a 4th time in 40 years we've seen it. The other 3 times this happened, the stock market fell apart. Why? Now, yes, the statisticians out there say 4 times in 40 years, it's not statistically significant. Yeah, I get that. But let me offer you what's going on here. When you go 9 weeks in a row with yields up, the stock market gets to its breaking point. It can't handle yields anymore at going up. And so yields have to stop going up. Well, what's one good way to stop yields going up? Smash the stock market. That's what we've seen happening in the last couple of weeks. And that's what we might see happening unless a central bank or somebody else artificially stops these yields from rising. This is the problem. And tying it back to my previous comment, this is why if we're in a bear market, you can't use bull market metrics to say this is the level of oversold. So, you said, can the market stay oversold longer than you can remain solvent? Absolutely, if we're in a bear market. And like I said, but if we're in a bull market, you could scream FOMO and TINA all you want, and the market keeps going up because it's a bull market. I'll stop there if you got any questions.
Yeah, Jim, let me follow up. With a question.
Hey, George,
go ahead. Go.
Jim, can you just repeat those years again? You said 94, 84, and what was the metric?
The 10-year yield is up 9 weeks in a row. So go back to August 5th. Every single week, calendar week, it's been up 9 weeks in a row. The last time that happened was the week ending April 1st, 1994. 9 weeks in a row it was up then to 10-year yield. The following week, the stock market was down 3.5%. Doesn't sound like a lot, but it was the worst week in 3.5 years. Prior to that, had yields. We all know this one probably. George, you probably remember this. Well, we were up 9 weeks in a row, ending the week of October 16th, 1987. So yields were going up. The 30-year yield actually went above 10% on that day as well. The following week was the stock market crash. The next one was May 25th of 1984. The following couple of weeks, the stock market had its worst correction since the bull market began in August of 82. Remember, that was May of 84, since August of 82. So when the stock market goes 9 weeks in a row, when the bond market yields go up 9 weeks in a row, what is my interpretation of that? That the stock market says, I can't handle this anymore. This is too much, too fast. And the reaction is pretty toxic every time it happens. And we finished 9 weeks in a row yesterday. And look at what the stock market's been doing the last 2 weeks going into that 9 weeks in a row. So either somebody's got to artificially stop yields from rising, or the stock market will do it.
So those were all during Fed tightening cycles, right? 84, 94, and 87?
Yes, they were. And we're in a Fed tightening cycle now, too.
And was it the Fed stopping that put that peak in yields ultimately?
No, I think it was that the stock market threw a riot by tanking hard enough that it kind of forced everybody. It forced the Fed's hand, or it forced the market's hand to stop raising rates and start worrying more about a reverse wealth effect leading to some kind of deep recession or a deeper recession or a recession of some type. And that's why you saw a rally in the bond market.
Yeah, leading indicators were not recessionary in either of those, or none of those three. So in 84, 87, and 94, it was growth rate cycle slowdowns, just slowdowns, mid-cycle slowdowns, not recessionary.
Yeah, and no, so I'm asking because those 84 and 94 are two of the 4 times the Fed was raising rates and we didn't go into a recession. Just what Kayfabe was talking about. I think in those periods also the economy was fine.
But we also had falling inflation too. We were past the inflation peak, and what the stock market corrections did in 84, now it wasn't as big as of course 87, was it halted the rate cycle. So that ended that pain. Point is that the pain of higher rates is really starting to hurt. And I'll repeat what I said before. Either artificially, somebody's got to stop it. And I say that because that's what the Bank of England temporarily did last week, at least in the UK. And there's been some spillover effect here. Or the stock market will stop this rate hike by selling off hard enough that it'll just change everybody's thinking.
So, Jim, could you a couple follow-up questions from me? Thanks, for that. It was really, really helpful. Great. The historical context is superb. Could you just, around the idea that we've seen such a rapid increase in rates, my humble opinion, I suspect yours, the UK pension situation is not, it's not the only, those aren't the only players who are going to get in trouble. What's the likelihood that there are some other people who are in trouble right now, severely compromised, and that just hasn't gotten public yet? And when you see a rapid move like this, a major economic variable, be it rates, oil, whatever, it takes a little time for the bodies to float to the surface, but it might be helpful for the audience for all of us in the room who maybe aren't as completely familiar with what happened in the UK. Maybe you could give sort of the Dummies 101 version of what happened, and then what's the likelihood that there's some other people who are similarly caught on the wrong side of this whole thing?
Well, to give you the bottom line is that there's like 100% likelihood that somebody's caught somewhere in a bad place because of this rise in rates. I was on the League Lag spaces a little bit earlier today, and I'll repeat what I said there. 10 years ago, in 2012, we had the London whale problem out of JP Morgan, where they had one London CDS trader that lost a boatload of money, and it led to congressional investigations and a giant write-down and a restructuring at JP Morgan. And there was calls for more regulation. And Jamie Dimon pointed out, in defense of JP Morgan, trying to fight back with more regulation, that every day, this was 10 years ago, every day they provide 700 desks in JP Morgan offices worldwide for regulators who have a full-time job of just looking at JP Morgan. 700 regulators spend all day looking at everything JP Morgan did, and nobody saw that coming. No one saw it. It just popped up out of the blue. The point is, these are not incompetent people. It's more of the case that the financial system is so bloody complicated and opaque that no one really understands what's going on. I used to joke that whenever you ask anybody about like bank earnings or what's going on in the financial system, there's two answers. Either you say it's too complicated to really understand, or you're making up something along the way. And so, yes, this is the problem with the financial system. It is very, very complicated and too difficult to understand. So when you look at things, and I tweeted this out on Wednesday, when you look at things like the MOVE Index, which is the Merrill, it stands for Merrill Option Volatility Index. It's the VIX of the bond market. Had its second highest reading in 13 years. Only the pinnacle of the panic during COVID in March of 2020 was one day higher than what we saw on Wednesday. When you see liquidity measures as measured by Bloomberg, it's some of the worst numbers that we've seen in 11 years. When you see financial stress measures like what Bank of America has, being some of the worst numbers we've seen since coming out of the great financial crisis, and understanding that the system is so complicated, I don't know who, where, how, when, or why, but I do know that this is the environment where people get in trouble. Now, why do they get in trouble? Most people on this call have probably never traded a bond, and I'll assume that everybody has never traded a UK gilt along the way. And the reason you don't trade them is they trade at par around 100. They have a very low interest rate, at least they did for the last 15 years. They're kind of boring. They don't do anything. I'd rather, trade Tesla, and I'd rather trade Apple than trade some kind of a bond. Besides, they don't even trade on a regulated exchange like the New York Stock Exchange. It's kind of hard to do. You're right. So who trades these things? Financial institutions. Why do they trade them instead of Tesla or Apple? Because they get to use incredible amounts of leverage in the bond market. And we use the word repo, which is a repurchase agreement. Go buy $100 million worth of bonds. Do you have $100 million to pay for them? No, but I'll post them as collateral and I'll take out a loan, a repo loan, which has a one-day maturity and keep rolling it over every day to pay for it. So you buy these things on lots of leverage. Now, that's not new. We've done this since the beginning of time with the bond market. So it is inherently a levered animal. So when you start playing around in the bond market, like raising rates aggressively like we've done, to seeing the worst total return sell-off ever, and I run that chart all the time on Twitter, all I know is when I look at that chart is I say, somebody's in a bad place. Somebody has to be in a bad place. There is no way the bond market, with all the leverage it has, can withstand that kind of a total return loss without there being problems everywhere, which way in Sunday. Now, why haven't we seen those problems bubble to the surface? Well, maybe we did starting on Wednesday in the UK. And let's be clear on what happened in the UK. They intervened, and the Bank of England put out a press release saying for financial stability reasons. That is code word for somebody was going to fail. Somebody was going to fail. They couldn't even wait till Thursday morning. They had to do it midday on Wednesday, and in the middle of a gilt auction. They threw that one into the middle of a gilt auction. That's how urgent it was for them to step in. And what did they accomplish? They forced the price of gilt prices way up. So at the end of the day, when you had to mark your positions to market, you marked them at a much higher price. Oh, good, I didn't break capital requirements. I didn't violate regulatory rules. I live another day. So what they did was a stay of execution, not actually fix the problem along the way. So yes, it's way, way too complicated to understand, oh, this person on this day is going to report this problem. But the environment and the losses and history says when you see this happen, there's going to be problems that bubble to the surface. And Janet Yellen made the comment, and I tweeted this out too a couple of days ago, where she said, we will never have another financial crisis in our lifetime. And she said, because the banks are properly capitalized. That is so off base, that is disqualifying. Because if you understand the financial system with all the leverage and the opacity, it is inherently an unstable system. It is prone to problems all the time. 2019 repo, 2008, the financial crisis, 2020, the response to COVID. Okay, we didn't know COVID was coming, but the financial system couldn't handle it. So that's why we had to have all of those massive interventions then. And maybe right now, this is how the financial system operates with all of its leverage and opacity. And so to say that we will never have another financial crisis in our lifetime just is a signal that you really don't understand how the financial system is structured. Yes, we survive these problems. Yes, but they don't go away unless we have first a lot of pain, which forces a restructuring, and then we move on from it. And that's where we're at right now.
Jim, thanks for that. That's terrific. I couldn't agree with you more. And I want to take your comment, and as our Maxi friends would say, Jim, I got to ask you before that. Jim, can we have an office pool? Can we start like a guessing game? Like when and if and under what conditions are you going to get rid of the laser eyes?
That's a good.
I mean, Jim, it's just not a good look. I mean, listen, Jim, we're friends. I'm not one of those ones who says he's a maxi. You're not a maxi, but Jim, why would you walk around? I mean, like now's not the time to go around with those glasses. Like you're just asking for trouble, dude. Like, why do you do this?
Oh, I know, because the laser eyes have grown into something much bigger than me. Look, quite frankly, between you and me, just don't repeat it to anybody. I'm kind of tired of the picture, and I wouldn't mind getting rid of it just from a picture standpoint. But I'm afraid that if I get rid of it, people are going to misunderstand what it means. Now,
right.
I do believe that the financial system could use a restructuring, could use a new idea, and decentralized finance. I'm a big fan of it. It's going through a winter. That's the whole thing with it.
So, Jim, if we were frat bro in college, I'm gonna pull this stunt on you now. I can't wait to see what happens. So, like, some guys are degenerates. Like when you're in high school, they would do pranks like. So we'll go out and get all those magazine subscription cards, and you fill out somebody's name on it, right? And next thing you know, said victim is receiving hundreds of subscriptions. Okay, it's like one of the meanest things you can do to somebody, right? So here's what, like you said, between us, okay, in a room full of 1,400 people, it's a good thing nobody heard what you said and is about to hear what I'm going to say. So here's what I want everyone to do. I want everyone to tweet out what Jim's new avatar should be and tag him with it. Okay. Jim needs help. Jim needs a new avatar and we need to help him. All right. So, and you guys, it never ceases to never underestimate the creativity, you guys. So either DM me or Jim or just put it out there in public. But we all agree it's like when my girlfriend says, "Hey George, you need new clothes." It's just something look good on you. Jim, those glasses got to go. I'm just sorry as a friend.
Okay. You just ruined my weekend. It's like I have to wade through 10,000 million tweets, but thank you very much. Field and Stream is on its way to you, George.
All right, I want to go to Neely and then Newman. Hey, Neely, what's up?
Hey, George. I wanted to go back to the consumer piece. As you know, that's my life's work, and the thing about the consumer holding up, I think I'm just becoming increasingly more critical thinking or possibly cynical about hearing those statements over and over again without really considering what's been going on in small business. I mean, small business very likely could end up being our subprime equivalent in this next impending financial crisis. Small business owners are consumers. There's 32 million small businesses in the United States of America. Small business owners employ consumers. They employ about 60 million people in the United States of America. Consumers are the economy. We have 160 million consuming households in the United States. I mean, this is not an insignificant portion of our economy, but candidly, it doesn't get a lot of rhetoric and research out there. And what we saw in September alone from each NFIB, the National Federation of Independent Business, as well as the Richmond survey, which just came out this week, the Fed CFO survey, it's not good. It's really not good. I mean, I think perhaps the scariest thing is on the NFIB numbers, the earnings results are actually trending back to pre-pandemic levels in that month, right? That time period where we shut down the economy for 30 days, but the PPP money hadn't arrived yet. I mean, we're back down to that level on that same sentiment indicator. And that still hasn't seen increases from healthcare insurance, property tax elevations, auto insurance, electricity and heating costs, not to mention rising rates on personal loans, business loans, line of credits, HELOCs. I mean, these are the things that keep me up at night over the weekend. Actually, I slept pretty well last night, but in general, these are the things that kind of keep me up, is we're not really talking about small business. And I'm deeply concerned, particularly as the EIDL loans, the disaster loans, start to go into repayment this month. So something we're thinking about.
Neely, that's terrific insight, because if you get away from this sort of top-down macro view of the economy, instead look at it from a bottom-up basis, maybe for more of an Austrian school, and we'll get Kayfabe to weigh in here. What you're saying is deeply negative, and as you rightly point out, it's a lifeblood of the economy. Neely, you mentioned 160 million households. How many businesses are there?
There's 32 million-ish sort of small businesses in the United States of America.
And any idea how many those are small businesses or total businesses, and how many of those
small businesses?
Any idea how many they employ?
About 60 million people.
So, and the workforce is what, 160 million or something like that?
Yep.
That's a huge number.
Yep.
Wow.
It is. And look, to be clear, we, in our business at Distill Advisory, we advise, public companies on economy. But what makes us unique versus every other economist that crosses that threshold right into their room is that we do economy. We actually have ownership in small businesses. So I'm stating this with one foot in reality and one foot in research. And, I think that's what concerns us. We were just with, some community regional bank folks even this week. And, obviously I won't share with what we heard, but what I can tell you is they're interested in this conversation. And I think, and it makes sense because, regional community banks care about consumers more than, kind of the big five in some ways. And I think we're just really concerned about the lack of rigor and rhetoric around this, because I think they're more levered today than they probably were back during the GFC.
I think
both
you're right.
On the consumer side of their business as well as their business side.
100%. Hey, Jim, Bianco, are you still there? If so,
yes, I am.
Could you weigh in just a little bit here? And by the way, for those of you that aren't a subscriber to Jim's service, I can't recommend it strongly enough. I'm a subscriber. I urge you to reach out to Bianco Research, get a free trial, and I think it's really a fabulous product. And Jim did not ask me to say that. I'm just saying that as a consumer of the product. Jim, some of the data you refer to in your research, you speak about, you've really focused a lot on the month-to-month inflation numbers, Cleveland Fed, and also some of the employment data. You've showed the quits, the difference for the room. Maybe explain what's been happening to wage costs year on year, also sequentially, and the gap in wage increases between those who are quitting their jobs for a higher pay or staying, and how that thing has been widening and widening. Can you just update us on the two key things here, which, we live in a world of month to month, but what you see happening on the sequential inflation data and also the jobs data?
Yeah, on the jobs data, what it is, first of all, there's a report called the JOLTS report, the Job Openings Labor Turnover Report, which it's like the old help wanted advertisements from newspapers, which used to be an indicator we were watching many years ago, pre-internet. And it shows that there's 11 million open jobs in the United States, and there's about 5.5 million unemployed people. So the ratio of open jobs to unemployed people is 1.98, almost 2. That is not only the highest it's ever been, it's far and away the highest that it has ever been. There are employers begging to get people back to work, even though we're at a 3.7% unemployment rate. Now, to be fair, just so everybody understands this, not every unemployed person is qualified for every open job. Either, if you don't have the experience, you don't have the education, or geographically, you don't live where the job happens to be. But there is no shortage of jobs. So what are employers doing to try and get people to get these jobs is they're paying up. The Atlanta Fed breaks down wage growth by job stayers, job switchers. On average, the United States has wage inflation of around 5.5%. That is, that's a very high number right now, and it's very problematic for the Fed because if you have 5% inflation, wage inflation, you could pay 5% inflation for goods, and that's not going to bring down the inflation rate anytime soon. But the job stayers, now there's more of them, is around 4% wage growth. The job switchers is around 7% wage growth. That 3% gap is a record. So we are seeing employers giving people premiums to switch their job. I have an open job. I want you to come work with me. You have another job. I'll just give you more money to switch to this job. This is problematic. I've argued this is problematic for the Fed because they want the inflation rate to go down. But if wages are going to stay at these levels, it's not going to go down. And you're also seeing it in the wage numbers too. Every month this year, payroll report, the next one will be next Friday, has been at least 300,000 jobs every month this year. The economists tell us we need at least 50,000 jobs to cover population growth. We're getting 300, so we're getting more than what we need. The initial claims for unemployment insurance fell under 200,000 this past Thursday for the first time in 5 months, and it's been in a downtrend now for a couple of months. So what's interesting is when people say, all these rate hikes are going to kill the labor market and there's problems in the labor market, look, I'm completely open to the idea. It will, but the current data, 300,000 jobs, 5-month low in claims, job switchers are getting 7% raises versus 4% raises, which is still a decent number to stay at your job. There's no top line evidence that the labor market is in trouble. Why is that important? Because for all the people that are screaming and yelling, the Fed's got to pivot because the labor market's falling apart, that's not the way they see it. Now, so they're going to continue with their foot on the brake, if you will, continuing to try and raise rates and slow things down.
George, can I just add one perspective to that?
Please, go for it.
Okay. So, Jim, totally agree with your assessment on the labor market. And I would say, the number one question we're asked in boardrooms right here, right now is, will we or won't we, be in a recession, or are we not? And, the we aren't camp is the only thing, literally the only thing they really have to stand on is the labor piece. And so the two questions that we respond back with, because any good consultant or professor, which is what I do in my free time that's my hobby, is you answer questions with questions, right? Socratically. And, the two questions I ask back is, all right, well, will a surprising rising federal deficit eventually lead to job loss or a slowing down, right? The inability to reabsorb the claims, because we got to talk about the deficit, number one. And number two, small business, right? I mean, I think that's the other thing that we bring up, and that's of great interest right now. And to your point on jobless claims and job openings, you're of course spot on because you're the man. It's job openings and it's jobless claims are kind of the leading indicators of the labor market, and that's what you look at. One thing, though, that we observed in looking at claims data this year, and the way we do it is we look at it on a 4-week moving average and we compare it with the base year of 2019. Tight labor market to tight labor market, like not year over year. Doesn't make sense to compare to last year or the prior year. You could say, let's look at it relative to the last time we had a tight labor market, 2019, just to see. And we've had 3 tremors in initial claims so far this year. And each one, to observe on them, each one has been met with immediate effect in slowdown in consumption. I think so. That's something key to keep in mind. Consumption defined by commentary out of the biggies like Walmart, Target, Nordstrom, Restoration Hardware, kind of the discretionary side, right, of consumption. And the other thing to observe when you look at the data this way is it's taken longer each time to reabsorb those claims. So it's not so much the fact that where we're at on an absolute basis, it's the next time we have a tremor, how long will it take? That's what we're looking at to get really, really surgical. But I really appreciate your comments. Thanks.
Yeah, thank you. The only thing I'll add 2 comments and then I'll throw a question at you. as well. The first comment is if you look at ADP does do an estimate of payrolls. It hasn't been very good in predicting the monthly numbers in the past, but they do break down the numbers by the hiring of big firms, medium-sized firms, and small firms. And I've also seen some other studies, you've probably seen them too. We cannot overstate that, like in the last 30 or 40 years, something like 100% of the job growth has come from small companies. If you're a big company that employs thousands of people, you're in the business of introducing technology and productivity to get rid of workers. The example I've used is today, the number of people on a GM assembly line to make a car is 12% the number it was in 1980. It's robotics and automation. So you're getting rid of workers. So where does everybody get their job? They get it from a company of less than 100 employees. That is where all the job growth is. If you have a problem in new business formation in companies less than 100 employees, you don't have any job growth because GM is not going to hire thousands of people. They're going to make more robots and get rid of people is what they're going to wind up doing. The second thing I'll throw out, and I'll do the Socratic method back to you. I'll throw out a question back to you. Greg Giff at the Wall Street Journal had a story last week about the change of attitude among workers after the lockdown and the reopening. There has been a complete reevaluation of the importance of work. And that, we call it the Great Resignation, we call it quiet quitting, it was called lay flat during Omicron, where you're supposed to do work in bed. But people are not willing to take a job at any price, nose to the grindstone, to start moving forward with their career. They'll do what they need to do to collect a paycheck, and to use a crypto phrase, they want to prefer to go out and touch grass and do other things with their life. Are you seeing that as well too?
I remember reading this article because obviously I'm an ardent reader of the Wall Street Journal, but also they were featuring nurses from my home state of Minnesota right on the front. So yes, very much read that article as well. This is actually the third topic that we're talking about very much in boardrooms. It's can you rebuild trust in the workplace? And from our vantage point, you have to go all the way back to April of 2020 when we decided to first fire 24 million people overnight, right? Secondly, claim that we had two classes of employees, essential and non-essential. We decided to, 3, pay the non-essential workers approximately 50 to 60% more at the lower bound of the income demographic than they were currently making while they were sitting at home during the federal pandemic unemployment compensation duration of 18 weeks. And then 4th, while that was happening, you had the rest of the workers having to do all of their jobs, right, with less resources, higher anxiety, higher, duress, basically, get paid less while watching their buddies stay at home and buy cars, RVs, and boats. So yes, we think there's been a fracturing of trust in the workplace, and we're just continuing to see this trickle effect of it. It's not just about the hours. I think it goes all the way back to that initial kind of trust moment being fractured because of the pandemic. It's a great question when we think about the questions of, what do we know because it's factual? What do we believe because we've invested the time to research it and care and have rigor around it? What do we not yet know? And that kind of stumps us. And what are the longer term effects? I would say that question sits in that third camp right here, right now. How do you spin that positively? It's an opportunity, candidly, for consumer brands and services to step in and be a source of assurance and trust, right? In a time when people are looking for that trust factor again. But it is definitely something to be contended with, and only a recession will kind of wash that out. This is when, this is when we get to finally, us nerdy economists get to finally put some spotlight on theory of moral sentiments and not just focus on the wealth of nations. So that's how I'd answer it back.
Just a quick follow-up on this subject. The Partnership for New York City, which surveys New York City offices, reported in September that only 9% of New York offices are 5 days a week. 16% of New York City office workers are now fully remote, more than go to the office 5 days a week. I've argued we're 2.5 years past the pandemic, and New York City, where you've got Jamie Dimon and you've got Dave Solomon at Goldman Sachs threatening everybody that they have to get back to the office 5 days a week, and you can only get to 9%, that the era of 5 days in the office is over. And we are moving on from that. And just as parenthetically, a couple of days ago, General Motors was pushing their office workers to go back 3 days a week, and they had to relent because they got so much backlash against it. That's important because if you take 160 million people, and half of those can be work from home. No, a doctor can't, a surgeon can't, a policeman can't work from home. So if you take 80 million people, and only 9% of them are in the office 5 days a week, where all 80 million were in the office 5 days a week before the pandemic. Now they're home 4 days a week, including Saturday and Sunday, or maybe 5 days a week, depending on if they go to the office 2-3 days a week. That is a gigantic lifestyle change. Your consumption basket changes. Your view on things change. The economy is going to be different with that kind of workforce, with that kind of time away from the office. You consume less services. You consume services because you were in an office all day long and you couldn't do things for yourself. Now you do things for yourself. You consume more goods, and the personal consumption data shows that. We are consuming relatively more goods than services. Relatively meaning we still consume more services, just on a relative basis. The percentage of services is falling and the percentage of goods is going up, but the percentage of services is still over 50%. So there is a massive change because of this coming to the economy. And I think the first level that we saw this was the inventory problems and everything else we've seen at the retailers. They're just now starting to get the idea that the 2022 consumption basket is very different than the 2019 consumption basket. And that is going to flow through to a lot of other things. And that's one of the reasons why I think that this inflation problem we have is going to be very persistent until we finally get a handle on what this new post-pandemic economy looks like and we start adjusting for it. But unfortunately, we'd rather argue whether there is a new post-pandemic economy. And a lot of people, basically at Goldman Sachs and JP Morgan, keep telling you there isn't. Just wait. In 2 years, it'll look exactly like 2019 all over again. Everybody will be back in the office 5 days a week. I'm not so sure that's going to be the case.
Say, Jim, that's fantastic, and you're so generous with your help. It really helping a lot of people. So I salute you. Just one quickie. I don't want to tell stories out of school, but and you tweeted out about this as well. In terms of the inflation numbers, you were mentioning how using the Cleveland Fed Nowcast, they're looking at September at 5.1%. So the whole, the crowd that was transitory that, is now saying it's peaked. And we've talked many times how the fact that it's peaked is not the issue. The issue more being the trajectory of the speed with which inflation comes down. And in a world where we live week to week, month to month, do you think the its peak crowd is going to be disappointed by the September inflation number?
Yeah, I think it definitely can. What that was, that chart, just so everybody knows, is last week during Chairman Powell's press conference, he made a statement that he would like to see all interest rates go into a positive real yield, meaning all interest rates go above the inflation rate. Then he went on to tell you which inflation rate he's referring to, core PCE. The August number was reported yesterday. It came in year over year at 4.9. Cleveland Fed does a real-time guesstimate. It's reasonable as to what they think the number would be right now. Their September estimate is 5.1%. Jay Powell just told us he wants every interest rate on the yield curve above the inflation rate. It's 5.1%. That's the one he's using right now. Interest rates, the high end is around 4.15, 4.18. The low, that would be the 2-year note, and the low end is the 3-month bill at around 3.30. If we take Jay Powell at face value, interest rates have a long way to go, unless you believe that the inflation rate is going to collapse. Now, I've been hearing for 2 years the inflation rate is going to be collapsing, and people are, still saying that. Maybe it does. But more likely, as you said, I'm in the camp too that's probably peaked. It's the trajectory that it comes down. If it's sticky on the way down, and it has been trending higher the last few months, and remember, this is core inflation. So we're taking out gas prices, we're taking out food prices. So the Ukraine war is somewhat insulated from this. If that is indeed the case, what Jay Powell just told us last week is he thinks interest rates have a lot more to go on the upside. Refer back to my comments about 9 weeks in a row of interest rates going up and how the markets are having a hard time handling that. Jay just told us we're just getting warmed up with the rate hikes or with the increases of overall interest rates. Something's got to give here. We cannot have these rates keep going like this, and the stock market decide, okay, now I don't care about interest rates anymore, and I'm going to start going back up.
Oh boy, you're a barrel last today, Jim. McFly, did you want to weigh in? McFly, please unmute yourself.
Yeah, George, I just wanted to add to Jim's very interesting statement there that the UK in June trialed its 4-day work week with over 70 companies and 4,000 employees. And I think, and I've heard the same happen in Germany. So when you start to see these trials being run across, G7 countries, they tend to be, what a picture of the future becomes. So I think it's very interesting you mentioned that, Jim. And there was another point as well. What I've seen is here as well is people misunderstand what these price caps are on energy. So since the Russia fiasco, the UK government has come out and said that nobody will have bills that are in excess of £2,500, or roughly the same in US dollars per year per household. Now, that isn't the case. What it means is that they will subsidize a price up to that moment, up to that amount, and anything above that will be charged at a much higher rate. So it is a form of rationing. It doesn't look like it at the moment, but if we see similar price rises in energy and we start to see similar policies implemented, I think we're moving into an era of less growth, less expenditure, more energy rationing. So it's very interesting when you mentioned that, Jim. I thought, hold on a second, I've seen this, and it's happening in more places than simply the US.
Excellent insight, McFly. All right, let's go to Mark Newman, and then after Mark Newman, we go to O'Hare. Mark, please unmute yourself, Mark.
Hey, everybody. George, another amazing space. I've been listening for quite a while. I've actually been able to accomplish things and hear great insight the whole way. I'm sort of sitting around the campfire and wanted to sort of address a couple things. I'm going to be quick. I just want to sort of food for thought along the way here. First, Neely, I really think what Neely hit on was important in the sense that, George, we know the zombie companies that exist in Japan and have always existed. I think the Russell has maybe less than 50% profitable companies in its 2000 index. And so Neely mentioned the banks as the key sort of source on these small businesses. I think that's critical, right? Because when the banks get in trouble, that's when sort of things become much more serious. I wanted to also add, McFly was talking about the put sales, and Kayfabe and I talked about this on Friday. There are banks out there that are systematically, selling 1, 3, and 5 day options, puts. This is their program. They've been doing it. They actually started it back around COVID times, and it really worked badly then, but they've redoubled their efforts. So that keeps vol a little suppressed. And I would also add, I was talking to some guys with the Tiger Globals and Melvin sort of out of the picture, and many with lower gross now. There is a little less reason for end users to be buying puts. Not everyone, obviously, but that also may keep vol a little bit more suppressed. I also wanted to touch on what Shrub said. I was debating in my head whether a slightly buzzed Shrub on Friday or a sober or the other day versus sober. It's equally invigorating and super great to listen to. I want to remind everyone of this sort of Adam Smith, The Money Game, when he talks about in this book of not hiring traders who have any memory, right? Someone else mentioned last week the global financial crisis already 13, 14 years prior. A lot of the people trading now are the new cycle of traders. And that is how these banks get into that same pattern. They hire newer, greener traders with no memory, and they're doing these 50-year trades, right? And as 50-year trades go, the more uncertain it becomes, the worse the 50th year becomes. So I thought that was something also for everyone to think about. And then finally, Kayfabe had mentioned I think it was Kayfabe, about the liquidity in Apple and the fact that Apple is still a couple hundred bips above the SPOOs for the year and 1,000 bips above the Qs. It probably has to trade down to the Qs like Microsoft and Google and Amazon have. And remember, I think it was against Shrub the other day. Apple's the most liquid thing in the world. So when people get in trouble, they're going to their most liquid, Apple, and doing their business there. And I think that's something very important to keep an eye on. Now, I'm going to circle back and just wrap it up with this. In the past year, one of the things we've seen a lot of places is civil unrest, right? Sri Lanka, Netherlands, a lot of places. And right now, as McFly hinted at, and Shrub did as well, the central banks and governments are putting price caps on things. This is to keep the bread and circus going and make sure that no one revolts. Now, Doomberg the other day on that Spaces talked about a cold winter. So I want to place this to everybody and say, what's the likelihood of G7 unrest in the next year based on all of this stuff that we're all looking about and talking about here? And that to me is sort of I wouldn't call it a black swan. It's probably a brown swan out there, the civil unrest nature based on all the things we're talking about. And then the last thing I'm going to say is, I know we always say it's not different this time. It's not different. Well, look, the TLT, my bond proxy, down 30% year to date. The Q's down 32% year to date. SPY's down about 24. That seems different this time. Like Jim's talking about the 9 weeks in a row, the bond yields rising. Like we're at a point where I hate to say different this time, but this one feels kind of different. So anyone can riff on any of that stuff, but that's the way I see things here. And I really love the Spaces, and like we're sitting at the campfire and the fire's burning hot. That's it.
Mark, always love your commentary. I had two questions for you. So you mentioned people going to sell what they can, selling their Apple and whatnot, using the FANG stocks perhaps as a piggy bank. And I saw something in FinTwit last night which showed for the first time this year pretty significant retail selling. The footprint that you see in the market and what's getting whacked and finally coming from the generals would seem to suggest that. Do you have any perspective on if, in fact, the retail investor is finally giving up, that the heat's gotten too hot in the kitchen, and we may be at the breaking point?
So I would throw this one. What I throw against the wall in this question, George, is, I've obviously been quite a big student lately and for a while here on the ESG aspect. And I talked to some people, and the funds that are getting launched these days, still about 70 to 80% of them have some ESG related baloney in it or whatever. It has ESG tags to it. The top holding in all these ESG funds is Apple. So if retail is in these funds, which I assume they are being, guided in, they're with the S&P weight at 7.3% of Apple, every $100 going into the SP type funds or even these ESG funds, 7, 8, 9% are going into Apple. 7, 8, 9 cents of every dollar. So I think people have been piled into this. And like I asked on Twitter and stuff, who out there doesn't, other than me, I don't know, who out there doesn't own Apple at this point? So I think there's still
Newman. There are some recently launched ETFs that will be short Apple. I can't say more than that.
Okay, well, you're not going to get a short cover in Apple, I can tell you that. Short interest is like 70 bips in Apple. There's no short cover coming. So unless there's the incremental buyer, and we know that those passive buying games by these ETFs are starting to dwindle, then I think that, who's the buyer up here at 25 times forward Apple?
Right.
I'm not.
So Mark, let me ask a slightly different question. Kayfabe, I want to bring you in here as well, maybe McFly. So it again concerns possible sellers. So I asked about, foreign central banks, where like we know the SMB, has got what is 150 billion portfolio in equities, and they own Tesla and all this craziness. And so to the extent that foreign central banks are now wanting to maybe prop up their currencies, stop them from going down further, and they go to sell assets, be they their FANG stocks or treasuries, because one of the things you're seeing now in Japan and elsewhere, the thought is that they're increasingly selling their treasuries. So first, to Mark, my question is less about equities; it's more about fixed income and bonds and just international capital flows. So I was wondering if you had any perspective, Mark, if you don't, or Kayfabe or McFly or anybody who's on the panel wants to speak up about this, the idea of foreign central banks increasingly selling their treasuries as we're into this sort of doom loop with a strong dollar. So to offset that, they have to sell their treasury or some other dollar-denominated assets. I don't know, Mark, if you want to take a shot at that, or Kayfabe, if you want to take a shot at that, or McFly.
I'll just take a brief one, a quick one. I think it was maybe Shrub the other day on maybe Thursday or the other space. Days get mixed up. He said something really smart, which was Apple. The day Apple got hit was the day the pound was rallying, right? And that was maybe. And look, Bailey Gifford is a huge UK based fund that owns a ton of Apple. They own a ton of Tesla. So they may be deciding to bring that money home. The last thing they want to do is sell their locals. And then the other thing, and then I'll pass it to someone else who may have greater insight. The dollar is so strong now relative to so many things. If you're long Apple and then you bring it home, the dollar, you sell Apple, you got your dollars, and you buy your own currency. That's a nice trade. I mean, I can speak. I've been long Japan tobacco. Okay, on the other side, and it's been done okay. And then I wanted to repatriate and do some other things. I sold that at Japan Tobacco, and then I had to bring it back to dollars. So I actually lost there. It was a good trade in the JT Tobacco to 29.14, but I actually had a bad currency translation. So I'm thinking on the other side, all these guys have been long Apple, and then the dollar's been ripping. That's a nice time to bring home some dollars.
Yeah,
So
100%.
I'll leave it to someone else.
Sure. Kayfabe McFly, do you have any perspective on possibility or likelihood of foreign central banks increasingly having to sell treasuries to offset the currency doom loop that we're in?
Yeah, I don't think it's just treasuries. I mean, I joked this morning that I've had the Swiss National Bank on my bear market blow up bingo card since May. When I wrote a piece and I looked at their balance sheet, I mean, it's not just treasuries. If you think about everything that a Swiss National Bank hedge fund would own, and they had at that as of the end of March when I looked at it, they had about 937 billion francs in foreign currency investments. So think about what's going on in currency markets, think about what's going on in rates markets, and think about what's going on in equity markets, and what that would mean to a leveraged hedge fund, and what their mark-to-market losses could be. So again, they have a 13F, so you can look up what they actually own in U.S. stocks, but who knows what they own in the fixed income derivative space and in the FX space. I could just again talking about the stuff that Jim Bianco was talking about. Where there's leverage, these kind of markets tend to go around and on a seek and destroy mission for leveraged players at different times, and in kind of a rolling seek and destroy mission. So now the question is, what will happen? Like, what will the Swiss government do? I'm watching the Swiss franc as kind of and the Swiss franc in the cross rates. As big of a problem as the yen's having, the Swiss franc's not making a new high versus the yen, for example, on long-term charts. Looking at it versus pound sterling, that kind of stuff. So I'm kind of watching the franc for signs that there could be some significant problems emerging at the Swiss National Bank.
By the way, you could also add in the Norges Bank and the price of crude, right?
Absolutely.
Crude's gotten smoked. Norges Bank's a massive owner of Apple, and if you see the krone, that thing's been dying a slow death too. So that's something to keep an eye on.
100%.
Let me ask a more general question for Kayfabe and Newman, because you're both very market-oriented animals. Step back for a second. I was going to blurt this out earlier. I didn't want to interrupt who was making the point. It was Jim Bianco. And I was just thinking more generally about leverage writ large. And Kayfabe, I apologize. You're such a prolific author. If you've written on this, I apologize. If not, here's an idea for a future piece. You don't have to cite me. But the idea of just leverage in general, forget about, UK pension funds. But Newman, let's go to the simple concept of pod shops, platforms. They all started in the aftermath of the GFC. That's when they really got big money inflows. And we all know why. They wanted to diversify their risk and don't take basis risk, take sector risk, and, long GM, short Ford, and then the next day you're long Ford, short GM, whatever, blah, blah, blah. So they run huge balance sheets, 5x, 10x levered. They have small basis risk. But the reason it works or would work, I mean, you can generate just a few percent return, and then you lever it up, and is the Englanders having a nice life out of it, all right? But you start taking your borrowing costs up, what works nicely at 50 or 100 basis points. And Thornton, you're down there, so I want you to come up here and talk about this because you have some of these guys as clients, and maybe Kantrowitz, you too. Anyone else wants to talk on this point? I'm just wondering, just getting away from the obvious stuff. Just thinking about, just more generally, the idea that the reason leverage writ large got pumped up so high, I mean, A, asset prices going up, but B, also the carrying costs are de minimis. So, okay, good. Here comes Thornton. So, Kayfabe or Newman, if you have a good answer, Tommy will have a better answer. And so now all of a sudden, where it's costing you 4.3% or whatever the number is to run these positions, not 50 basis points. And you got a negative carry, not just because the borrowing costs are so high, but the prices are going down. Seems to me it's a formula for massive, massive leverage reduction. So I'm putting the cat amongst the pigeons. I'm going to let Thornton go first since he was energized enough to jump up here and he hasn't had his chance yet. So a beautiful day in the neighborhood, a beautiful day in the neighborhood. Tommy, will you be mine? Will you be mine? Please unmute yourself, Tommy. Thornton, you there? Unmute yourself, please. We can't hear you. All right. He doesn't want to talk up.
Georgie, in one word, liquidity.
Yeah. So doesn't it mean a collapse in liquidity, Mark?
I would think so, because all of a sudden, your dry powder has gotten sucked out and your positions have to get smaller. So you can't be there to absorb more or buy more. Or something
yeah. So Newman, even if prices weren't going down, let's just give a thought experiment for the room so they can understand how this works. Even if you weren't getting killed and prices going down, if your overnight funding cost is 1% and then it goes to 4%, ceteris paribus, doesn't it mean you got to reduce your balance sheet? You can't. The economics don't work.
Oh, absolutely. And I've known some folks at those shops you talk about, and at 1% rates, they're kids in candy stores. At 6% rates, they're diabetics, and there's nothing they can eat on the shelves.
So isn't this sort of like, this is a real hidden, I mean, this is not front page news for, on the Wall Street Journal. Yeah, okay, fine. The UK pension funds are front page news. They blow up because they had a carry trade on. But these platform companies, you take Citadel, Millennium, all the names, doesn't really matter. If they got 30 or 40 billion in assets and equity capital, and then I've been shocked. I know Thornton's seen this, Kayfabe, I know you see this. So whoever's mic is working should speak up. These guys running like $200-300 billion gross positions. I mean, Newman, explain to me how this isn't just disastrous.
No, that's the massive leverage game that everyone's in riding. And look, I think let's just look at Credit Suisse, right? They seem to get over their skis, and then all of a sudden, when the snow's gone, they realize they're on a double black diamond headed straight down. And I think that, things move fast. And we've seen that. I think Jim hit on it. I think Shrub hit on it. Like, all of a sudden, the 20 times levered bank sounds better than 100, but it's still 20 times levered. And so you do hear about that Citadel guy, the Citadel guys. They have these positions that are they're more than 20 times levered, which is why a guy like Ken has the ear of a lot of people on the inside to say, look, it can get messy fast if we don't fix something. So it feels like we're kind of, I think most of the people in this room have been saying similar things in different language, not different voices. We're kind of teetering close to that.
But Newman, I love you. By the way, I'm gonna have to go back and listen to the recording so I can get the clip just right for the quote, because I'm gonna use it. I'm gonna make you famous. I love what you said. We get over their skis, and before they know it, they're going down the little black diamond trail. I'm just got the vision in my head of a ski jumper, and they're kind of at the top, and they're waiting to go. The system from where I sit, they already started down. They just don't realize it yet. In other words, you're inevitably going to have forced balance sheet contraction on all these crazies with their massive leverage, with attendant consequences that I don't want to describe graphically because it'll scare all the women and children in this room. I just don't see any other way. I don't know, Kayfabe, you want to push back on that? Agree with that?
Yeah, this is right in my wheelhouse. So the legacy risk models that everyone runs, or most everyone runs, is all normal distribution, All the machine learning off of the last 20 years worth of data that everyone's been doing is all kind of using the same kind of statistical modeling. And the problem is that instead of using that kind of modeling, and that's very good when you're in a mean reverting kind of normal environment. But when you get into an environment where the system's unstable because of all this leverage that's built up, you introduce the dynamics of the sand pile model, which is basically nonlinear. This is kind of what Nassim Taleb talks about with fooled by randomness or black swans. It's when the distribution shifts to something like a fat tail. And this is seen throughout the natural world. I mean, it's you can use all kinds of analogies with this. So what leverage does in financial markets, it's like snow on a mountainside. And once the avalanche starts, the question is, how big's the avalanche going to be? And this is what I've been writing about since the beginning of the year. The avalanche started. I mean, the first kind of rumblings of at the top of the mountain starting the avalanche was when the ARCs and all the hyper growth crap peaked in February of 2021. And ever since then, it's been rolling down the mountain and picking up speed, picking up velocity, and sucking more and more parts of the sand pile into it. And another characteristic of this is hidden interdependencies, which we've been talking about, is where stuff just starts to break on the other side of the mountain. You didn't even know there's an avalanche going on in the bigger part of the mountain. And all of a sudden you get sucked into it. So that was the UK this week. And there's going to be more of them, whether it's the SMB or, stuff that we can't even think of right now, because they just seemingly come out of nowhere. So this is all kind of classic complex systems, sand pile model behavior. And to your point, George, it is the leverage. The leverage is like the grains of sand or the snow on the mountain. And as you pile that up, and that's, this is when I went on my rant moralizing earlier, is we keep letting this happen, keep incentivizing it through policy, and then bailing out the leveraged assholes when they inevitably blow it up. I mean, this is predestined. This is a feature, not a bug.
Yeah, Kayfabe, I totally agree with you. You and I see eye to eye on this, and you've heard me moralize about this before on my own, where I keep saying that this blowing up is a good thing. It's a necessary part of the healing. We have to blow this stuff up and destroy this stuff so we can start over again. Otherwise, as you say, we just keep piling more and more leverage on top of the whole thing. So,
but what's going to happen, George, is Kenny's going to get on the phone to the New York Fed as soon as it's the same. Another milestone on this whole beginning of the crisis was when they took the buy button away from GME, right? What was that to do? That was leverage. That was system leverage because of market makers not being able to handle the gamma squeeze, and the whole system was on. That was another version of what just happened in this UK fiasco.
100%, 100%. By the way, Kayfabe, I don't know if you saw it, but I'm gonna actually make you co-host. I think I'm reserving the co-host spot for you Monday at 4:30. John Hussman. Monday at 4:30. John Hussman, and John rarely makes public appearances. I had to use a little connection to pull to get him to come to agree to speak, but he will be with us at 4:30 on Monday, assuming that there isn't any last minute crisis, which he warned me there might be. And one thing I want to say to everybody in this room, John, he has an autistic child, and I believe he's a big benefactor of autism, and I think he might even have a foundation. So we are going to, I think, and as token of our appreciation for John, I'm going to solicit everyone to give to his autism cause on Monday. He's doing this as a real favor. He's really smart. And you know what, Kayfabe, I want you to talk about Hussman for a second. Viewed through the lens of what you just described. John is like, he's up there. He's like one of the smartest guys in the room. He's in that Jeremy Grantham league, all right? And people make fun of him. Twitter bro and dudes who are only concerned with number go up, they poke fun at him. He was early. He was wrong, whatever you want, okay? But I always like to say that, sometimes the market makes you look smarter than you really are, and sometimes it makes you look really dumber than you really are, okay? The people who are bearish on Japan, Newman, you don't have to speak up. You could just punch your avatar smiley thing. The people who are bearish on Japan in December of '89, having looked like idiots, were they dumb? No. It's just the mania overran everybody and made them look dumb. All right, and in this sewer of FinTwit, you have these Twitter bro with their Discord rooms. These 25-year-olds pontificating on why you have to own Nvidia and ARC. They don't even know who John Hussman is, but the elder brethren will make fun of anyone who thinks value means anything. And Mr. Markets made John Hussman look foolish. But I'm teeing this up for a question for you, Kayfabe. The longer this has gone on, and it's gone on for God knows than any of us could have ever imagined, or John Hussman could have imagined, to me, it just adds up to, it means A, was the leverage that caused it to happen, and B, when the underlying comes, it's going to vastly exceed, it's going to be a tail. It's going to vastly exceed anyone's expectation. And so I think John Hussman's moment of redemption has arrived. I can't wait to hear what he has to say. And you want to riff on that, Kayfab?
Yeah, I have a lot of empathy for John. I don't know him personally, but I've been following his writing for, pretty much 22, 23 years. And at one point, I actually had a pretty large amount in his funds, his primary fund. But I actually pulled it in September of 2008 because I saw he was kind of going on tilt, meaning that, and I've done it myself. You've done it, George. Like you have this, and as you mentioned earlier about Cantrell, you build this process that you trust, and then because we're all human beings and our egos get involved, people violate their own process. And I saw John doing that in September of 08, so I pulled the money, and I think he got on tilt in 09, 08 into 09, and I think he kind of flailed around a bit, trying to figure things out. And I have empathy for that because I've been there. I've done that, right? So, but I to your point, I think he's kind of got his legs back under him, and so I generally agree with you that this is probably the season for his kind of strategy. I think has finally arrived. And again, this goes back to trailing performance. His trailing performance is atrocious. Like it is what it is. You can't pretend it's not. But that's looking back. And the question is, what is he doing? How does he do it? And does it match what's in front of us? And I'd argue it very likely probably is. And having gone through that, that period of humility, and I can only imagine how, difficult it was for him from an intellectual and emotional perspective. I'm sure he's learned from that. So I think that will probably make him better going forward as well. And I don't feel that bad for him because I'm sure he's been healthily compensated through all this. But, you still have to have that kind of general empathy as a human being about, when you go through that long of a period where you're really underperforming and not doing well, as you know, George, it's like being in a living hell in this business.
He's the opposite of crypto, bro. He's the opposite of crypto, bro. For them, it's all about number go up, ends justify the means. There's no fucking process. John Hussman, it's all process. And he's brilliant, but he missed a couple things. He just got run over by the leverage in the biggest explosion of liquidity in the history of the world. Japan's got nothing on this market. So again, 4:30 on Monday. I urge everyone to come and listen to John speak. He doesn't speak very often. So this is a huge deal. A very fortunate get. And by the way, Kayfab, offline, I'll tell you who else we got coming. This is going to make your head explode. I mean, this one is just going to bring the whole house down. All right. Tommy Thornton, can you unmute yourself? I think we got you up there as a speaker, but I think we can't hear. Oh, there you go. Tommy, can you speak?
Hey, how are you, George?
Excellent, Tommy. I don't know how long you've been in the room for. I know I've seen you for the last half hour, but I think you heard my question about leverage and the effect of declining. The fact that just to restate the question, much higher short-term rates, what that does to books, what works if you're, again, not speaking specifically, but just generally, you've worked these places, people at these places. What's the impact? Well, a couple questions. A, the impact on positions overall on the street, just when you raise rates like we have, and then particularly the pods that these guys, because they're not caught offside necessarily in any one thing. They're not like, well, actually, they are in a very big sense. They got a huge carry trade going on. They're borrowing short and they're investing on a market neutral basis long. So just speak to how you see exposures up and down the street, particularly focusing on the pods as a result of this increase in interest rates, Tommy.
Okay. Well, I have a couple things about leverage as well, but as far as some of the positioning, I don't think hedge funds are positioned uh, as offsides as they typically have been going into these types of fiascos. We've seen a lot of exposure taken off. I think I saw that some of the desks are saying that they're at some of the lowest exposure they've seen in quite a while. So I think that that's uh, maybe a positive for hedge fund people and the pods. I still think there's like companies like Citadel that you don't know what they have because I can't confirm this, but I think it's true. They rarely show a 5% or greater position weighting or in holder weighting, and one of the reasons is that once they tick over 5%, everything moves to swap, and so they can keep that stop. They don't have to file that they're a holder. So there's probably a lot of those out there. Uh, Probably the desks that have been the lending desks and the prime brokers I picked up on the Bill Wang, and they don't want to get wanged again. Um, but it's possible with a big one. And the other thing is we're not talking about necessarily funds. We're talking about frickin' central banks this go, and that is really pretty scary. And one thing that I remember back in 2000, late 2007, and when I was at my fund, we had Ned Davis in our office in our conference room, and one thing that he said really stayed with me, and it was eerie because it came true. He said, when everything starts to break down in the markets, and they will, you're going to find people that you never thought would need a redemption are calling you guys up saying, can you send me money? And that was very true. We didn't have, it wasn't a massive amount of redemptions because we had a good year in that period. But that really could be something that we see in the next quarter. And one thing about, I wrote about this, and bear with me on this. I've looked at like chaos theory, where you have these something that you want to solve a problem or fix a problem, and you fix the problem by doing more of the problem. And one of the things that I've talked about is back in the 70s, early 70s, in Cape Cod and Nantucket and Martha's Vineyard, everybody, all the conservationists were worried about the seals. And so what they did is they did this big conservation plan, and it worked. It worked. Seals are everywhere now. They're everywhere. And guess what happened? They created even more problems with fishermen not having the same amount of fish to catch. And this is even worse. There's more sharks in the water. So you're seeing more sharks uh, patrolling the shores of Cape Cod and Martha's Vineyard and Nantucket. It's just like the central banks. They solved the problem, so to speak, after the great financial crisis and created an even bigger one. Now, I saw a chart of total market cap, including stocks, bonds, just about everything, the drawdown in trillions of dollars. And it's stunning because there's never been a bigger drawdown in history. And I forgot who put it out. Somebody sent it to me. I'll find it and I'll tweet it out. But you also have to remember that over the last 10 years, the amount of market cap increase and leverage and bond issuance has gone up exponentially more than when we were in the great financial crisis or before the crisis. So it's like they've created something by trying to fix it. And yeah, I saw what happened with the Bank of England, and they bent to save some things. And usually, as I said the other day with you, George, usually you see these places, the LDIs that are, somebody that sent me the chart just texted me. Usually when you see the most conservative strategies blow up, it's because they just were thinking, this is safe, let's lever it up 10 times and we're good. Happened with long-term capital, happened with a lot of other, banks in the great financial crisis, and it's happening maybe now with maybe some central banks. I mean, I've thought there's going to be a central bank that tilts this over, and I think we're kind of on the cusp of it. That's it. And I hope my seal thing translated for you okay, George.
And Tommy, by the way, is someone who, before moving to the New York area 6 years ago, living in Boston for 35 years, I owned a place on the Cape in Chatham for 25 years. I had my 19-foot whaler, and I'd go out amongst the seals. And I'm well aware of the seals. We routinely would go out to watch the seals. And yes, now, but you forgot to mention the biggest unintended consequence of what happened, Tommy. I got you on this one. It's going to be checkmate. I'm teasing you, my friend. Shark tourism has become a big thing on the Cape. So, because of all the seals.
I'll pass. I don't want to be in a whaler, 19-foot whaler with a 12-foot great white.
But plus, you don't want to be in a whaler period with me, because I don't know what the hell I was doing. But anyway, it's either here or there. I really appreciate the time. That's awesome stuff. All right, guys, this has been a lengthy room. We had a technical delay in the middle, but hopefully you all enjoyed it. And see you again soon. Everyone be safe. Take care. Bye-bye.